On this Friday, October 18th, welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith. Let's get to the three things that you need to know this morning.
Hey, good morning, everyone. First up, earnings season continues with Netflix. Yes, we're still watching, posting strong results as the streaming giant topped Wall Street expectations across the board. Meanwhile, consumer giant P&G, they're reporting some weak sales growth this morning, while American Express lifted its full-year guidance. All eyes now turn to Tesla to kick off some of those magnificent 7 earnings. Next week, the company faces a U.S. probe, though, over its full self-driving system and whether the technology is defective after a series of crashes.
And turning to the broader market, U.S. stock futures, they are mixed this morning on the back of strong earnings results and the latest data that we got out on housing. And that showed U.S. housing starts easing in September. The S&P 500 hitting a record high yesterday, Thursday, led by a rally in NVIDIA and the rest of the chip stocks. Investors are seeking some safety, though, this morning amid escalating geopolitical tensions. You've got gold reaching a new record high.
And also in corporate news, CVS announcing a new CEO after numerous quarters of missing earnings estimates, ending a tumultuous tenure for Karen Lynch. Shares tumbling here pre-market after preliminary results showed profit falling short of estimates in the third quarter.
Let's kick it off with Netflix. You're looking at gains in the stock in extended hours, up just about 6.5%. Shares rallying to the upside after the streaming giant beat on both the top and bottom lines, as its ad-tier memberships jumped 35% from the previous quarter. To discuss the latest earnings print, we want to bring in Jason Bazinet. He's Citi's managing director. Jason, it's great to have you back. So you're taking a look at some renewed optimism, it looks like, on the street. Stock moving to the upside on this move, except you remain, I think it's fair to say, maybe a bit cautious with your neutral rating. Why?
Well, let's see, what can I tell you? The fundamentals were really good, so there's nothing really to pick out there. What I'm a little bit nervous about is what I would just call the sort of shifting bull case on the stock. And what I mean by that is, at the beginning of this year, the bulls were looking for a bull case of 625, which is essentially $25 per share of earnings in 25 at a 25 multiple. You talk to those bulls now and they've moved to 26 and they want to put a 30 multiple on it. So they're now saying 30 times 30, so $900. I just get uncomfortable when I start hearing that, because when you have multiple expansion like that, you usually need an accelerating top line. And Netflix's top line is actually decelerating as we move forward. So they're going to do 15% growth this year, and they're guiding to 11 to 12% growth next year.
And so with that in mind, how much are they going to need to spend in order to see that growth come to fruition, Jason?
Well, it's really interesting. I mean, this gets back to another one of my areas of concern. I mean, they talk about their engagement being up, but it was up only 1%. And so the question is they're spending a lot of money on content, but they're not getting the response function in terms of deeper engagement. And so it's really not a question of how much do they have to spend. I think it's more a function of, are they spending on the right things that will cause consumers to stay glued to Netflix, get those engagement numbers up, and then allow Netflix to take price.
Jason, what do you think would do that?
Well, so the scuttlebutt is that they are trying to focus on a lower volume of content, but focus on more marquee content that's going to cause sort of excitement. And so I think that's sort of the shift that I anticipate, is maybe fewer hours produced, but higher quality. And Netflix has said that they really want to buy IP. And I think that's one of the things that Hollywood learned a long time ago, is that you need IP to really ring the cash register, on these iconic, stories that are out there that really get people engaged. And you can do that if you don't have IP, but it just is a much higher risk proposition.
Jason, you're cautious on Netflix, as we've been discussing, but the company's stock is up over the course of 2024, up by about 46%. Over the past year, it's up nearly 100%. So all these things considered, I mean, some of those headwinds, we could argue, have been at play for a while. They were talking about how much they wanted to spend on licensing. They were talking about getting more into sports. That's more so those dollars out the door and trying to figure out where they could carve out space for them to compete. And so it seems like investors are putting that to the side, even with some of the concerns that could be prevalent. That's not playing out in the story for shareholder returns right now.
Well, yeah. So let me just step back a bit. So we caught a lot of that upside in the stock. We downgraded it in January of this year. And I think this is what I think is really going on, which puts fundamental analysts like me in a bit of a quandary. What I think is happening is portfolio managers that were overweight, sort of the Mag 7, are calling their analysts and they're saying, give me what I'll call a tier 2 tech stock that's not a Mag 7 stock. And so the analysts all come back and they say, oh, Netflix. And so what you're seeing is money sort of come out of those Mag 7 stocks into Netflix, and that's resulted in multiple expansion that's not really underpinned by as much earnings growth. And so it puts me in a difficult spot. Could the multiple go to 35 times? Could it go to 40 times? Could it go to 50 times? It can. But in my seat, what I like to see is things where the multiple's expanding and the fundamentals support it. And that's not really what's happening here.
Jason, how likely do you see further price hikes? And when you take a look at the fact that, or the risk here that subscriber growth can slow, are price hikes then almost unavoidable then in that situation?
Well, what the bulls wanted was they were looking at sort of all of the streaming competitors that Netflix has that had all taken up prices, right? Because they're all trying to generate some modicum of profits in their streaming business. And so the buy side said, well, Netflix will take prices up too because everyone else is. And Netflix will only take prices up if engagement is up. And so it's a little bit, we don't have the engagement levels down by geo, right? We just know what they are in the aggregate. In aggregate, they're sort of flat. Whether they take prices, it's going to be a function of how good their content is and whether they can get the engagement numbers up, not whether competitors are taking prices up.
Do you think they have the ability to do that at this point? Or will there be a backlash?
I don't. I mean, I'll leave you with one last thing. I mean, when we were bullish on the stock, we told the street they were going to get 80 million ad tier subs, right? Which is about 25% of the total. You mentioned on your slides that the ad tier subs were up 35%. But they said that 50% of the gross ads that are coming into the ecosystem in those 12 ad tier markets are taking the ad tier. So what does that tell you? People want cheap Netflix and they're willing to endure the ads. And so the sub growth is not a function of a ringing endorsement on the part of consumers saying, I love this. What they're saying is, I love the price more than I love the content. And that's what's required to get the marginal net ad into the ecosystem, low price.
Just before we let you go, Jason, one more quick question. What is the key region that Netflix needs to get right in order to stave off competition from activist investors who are looking at some of their portfolio and saying, hey, why can't you get margins like Netflix? And we know that they're going to be all kind of hyper-focused on making sure that they can have this international expansion that also adds to the bottom line. What is the key region that Netflix needs to lean into?
Boy, I don't know. I mean, that's a very difficult question to ask. I wouldn't say that there's any single key market. What I would say is if this narrative that we're in the sort of early innings of, the ad tier sort of moving the net ad lever because it's low priced, then the corollary is you want to see traction in those 12 ad tier markets. And why did Netflix pick those 12 ad tier markets? Because there's large ad dollars in those markets. And so it's all of this sort of developed economies that you can think of, right? The US, Canada, Japan, Germany, the UK, that's where they really need to move the needle because they can go out and offer in dollar terms a $7 ad tier price and then make up $8, $9, $10 in advertising revenue over time. That's going to be the next chapter of the Netflix story in 26, 27, 28.
All right, Jason, always a pleasure to get some of your insights here too. Thanks so much for joining us here this morning, just ahead of the opening bell. Jason Bazinet, who is the City Managing Director. Good to see you.
Thanks, Brad.
Let's turn now to some of today's trending tickers. And guess what? We've got a QR code that you can scan below. It's got the best and worst performing stocks of the session. Yahoo Finance's trending tickers page. That's what it'll lead you to. Go ahead, scan that. All right, while you're scanning, first up, let's talk about CVS Health. CVS Health replacing CEO Karen Lynch, naming David Joyner as the company's new leader amid some ongoing financial struggles here. Now, Joyner has been the president of CVS Caremark, the company's pharmacy benefit manager, the PBM side of the business. CVS also withdrawing its 2024 profit forecast and warning that third quarter earnings will miss Wall Street estimates when they are released on November 6th. So these just preliminary updates that they're giving. Shares, no doubt, though, reacting quite harshly, down by about 7% here pre-market.
Yeah, I think for CVS, similar to maybe what we've seen at Walgreens, just in terms of the ballooning cost, that has really been a massive challenge here going forward. In terms of their new CEO, David Joyner, again, like you were just saying, he was a longtime executive, but really what stuck out to me is the fact that he has been president of Caremark, their pharmacy benefit manager. So again, that kind of signals the direction there of CVS and where it's going, which maybe comes as a slight surprise. But again, when you take a look at maybe where their priority will be going forward, that of course is a part of the narrative here this morning. And I think that this move doesn't necessarily come as a massive surprise maybe to the street, just given the fact that CVS, like you were saying, has far underperformed the broader market this year, has been under a bit of pressure. Their former CEO had been faced with a lot of questions, even some activist pressure there in terms of pressure to change things in the direction of the company moving forward. So again, this move here to replace the CEO, I think the question is, what many analysts are asking this morning is what the timeline is going to be for that turnaround and exactly what that playbook looks like, because they need to act quickly in order to prove to the street that they are moving in the right direction and win back some of that lost confidence.
Yeah, and just one more note on the lost confidence. It's not even just the lost confidence in some of the executives and the leadership leading to this changeover. It's also some of the lost confidence from the customers, and particularly you look across the Medicaid coverage, that has seen a recent hit in some of their quality ratings among the plans that CVS Health manages. They mentioned that back in August, actually. And so that's going to be a larger kind of mind share and broader sentiment turnaround that they're going to need to lead as well under this new leadership.
Yeah, certainly, again, a name to track today. It is off the lows that we saw in earlier pre-market trading, but again, under a bit of pressure on the news of the new CEO, but also the preliminary results that were announced here this morning. Let's take a look at American Express, another name that's on the move this morning, reporting better than expected third quarter profit, lifting its full year guidance. Yet you're looking at shares still under pressure, off nearly 4%. Now that full year guidance lift was boosted by strong consumer spending. The stock hit a record high yesterday, so we are seeing a bit of a pullback here. What stuck out to me was some of the commentary that we're getting here, not only on the earnings call or in the earnings release, but also Amex CEO Stephen Square had a chance to speak with our executive editor, Brian Sozzi, and he was just talking about how upbeat he is on the consumer, at least in terms of Amex's exposure here at this point. And this quote up on the screen right now, the reality is you do really have a bifurcated economy here. Our card holders, which are premium card holders, have had money and will continue to have that money. So that helps explains the guidance raise here that we got out this morning. But again, it doesn't look like this is enough for the street, which could be a bit surprising. But remember, it did hit that record high yesterday. We are looking at a bit of a pullback here in pre-market.
Yeah, you know, this is for an American Express company that really kind of leans towards that premium consumer, and you look across the card holder base that they do have. I mean, they had even gotten a nod from our conversation with Delta CEO Ed Bastian when he was talking about the consumer and the premium consumer, and looking through one of the measures that they have on their side, which is actually American Express remuneration, and the kind of level of that was actually up high single digits. So that kind of gave you an early insight into what Amex might have been foretelling about the consumer and might have been able to tell us in their earnings. And they've done just that. And there were a lot of bright spots actually in at least the year over year increases in kind of the build business. You look at total revenues, that was up overall. Total revenues net of interest expense up by about 8%. And then the net income, that was also up 2% here. But of course, investors perhaps have some lofty expectations with this one. At least right now, shares are moving lower by a little more than 3.6%. Finally here, let's take a look at P&G. Procter Gamble reporting some weaker than expected revenue in its first quarter as slowing demand in China weighed on volumes here. We're looking at shares. They're ticking lower here, pre-market trading. Yahoo Finance executive editor Brian Sozzi. Brian Sozzi sat down with P&G CEO John Moeller this morning to break down the results and the state of the consumer. Take a listen.
Well, one of the big questions, and we've talked this previously, is can we grow meaningful unit volume at the new prices that we've moved to as a result of the commodity cost increases. And the resounding answer in large developed markets like the US, like Europe, is yes. As you indicated, volume growth up 4% in North America in the quarter that we just completed. 8 out of 10 categories growing volume share. If you look at it over a longer period of time, the last 5 quarters, we've delivered between 3 and 4 points of growth from a volume standpoint. So indicative of a very strong consumer that's being offered a very good value. Europe, plus 4% volume growth in the quarter that we just completed. Same story over the last 5 quarters, a little over 3% on average. So back to the question on can we grow unit volume at these price levels, the answer is a resounding yes. Does the consumer continue to exhibit signs of health and a desire for, or continued desire for our products? Yes. If you look, for example, at private label shares in North America as indicative potentially of some dissatisfaction with the value that our products are providing to consumers, it's the market share from a value standpoint is flat, past 3 months, past 6 months, past 12 months. So we are very encouraged by the results in both of those markets and frankly, about 85% of our business around the world.
Are you seeing a tale of 2 different consumers in the U.S.? You know, I was recently spent some time with the Walmart team and also digging into their results. Like, they're doing really well. Target doing okay, but then the other end of the spectrum, you have these dollar stores, and that consumer seems really pressured. What are you seeing on a consumer standpoint?
We do see, of course, as you would expect, some dichotomy between different groups of consumers. But at the end of the day, first of all, we try to ensure that we have offerings that are available across the price ladder for consumers who have different outlay needs. We also ensure that in channels where incomes tend to be a little bit more stretched, that we offer a pack size that is friendly from a cash layout standpoint, which ends up being important to a group of consumers week on week. But generally, if we, these are daily use categories, they're essential categories where performance drives brand choice. If we're conscious about providing a good value, holistically defined, price, performance, usage experience, things tend to go fairly well, as they have been.
John, I talked to a lot of CEOs in the packaged food industry, and now I think they're ready to offer perhaps some more promotions on their products to dial back some of that inflation. Now that inflation has pulled back a little bit, how does that look like inside of a packaged goods company like yours? Are you going to pull back on some of those price increases?
Well, based on the data that I just indicated and based on the cost trends that we see, which of course involve a different commodity basket than some of the food or beverage companies, we're very happy with where we are. We're never happy with the total amount of value that we're offering consumers, and we're going to keep working on that piece of the equation, primarily through innovation.
Coming up next on Morning Brief, we'll continue our earnings coverage and push ahead to Mag 7 results kicking off next week. Plus, we count you down to the opening bell on Wall Street after the S&P 500 notched yet another record high. And from public markets to private, we hone in on investing in AI as new reports show signs of stress in Microsoft's relationship with OpenAI. We've got all that and more on Morning Brief.
Third quarter earnings season for the big banks is in the books here. The majors posting strong results, mostly boosted by investment banking and wealth management. But one exception to the positive news was Citigroup CEO Jane Fraser did not immediately refute a question during the company's earnings call about whether regulators had placed a new asset cap restraint on the bank. That sent the stock lower and had Fraser later trying to end the speculation about regulatory scrutiny. Joining us now, we've got Fadi Masih, who is the Moody's Ratings Associate Managing Director of the Financial Institutions Group. Great to have you here with us this morning. So what does the path forward look like for Citi, and did we get the clarity that we were looking for around this rule change in this cap?
I think we did. I think Citigroup continues to urgently execute on its risk and control transformation. Actually, the profitability was, although weak, heading in the right direction with positive operating leverage across all of its business segments. So I think one quarter was not going to change the story, but it is a positive move in the right direction. Overall, it was credit neutral from a credit perspective.
Fadi, so then I guess the market's reaction that we've seen, or at least the underperformance of Citi relative to some of its peers, is that then, does that reaction make sense to you? Or was it still, though, a bit of an overreaction given the fact that you're so positive on the trajectory going forward?
Yeah, I won't comment on the stock. As a credit analyst, I'm more focused on the fundamentals. And I think taking a step back, the big six banks that have reported results have very strong performance. There are some outliers, but capital markets was a very strong point, especially in M&A, where activity is starting to pick up again. Trading volumes were very strong, so that translated into strong profitability, and expense management was pretty good.
And so all of these things considered, I mean, it kind of falls in line, or at least the bank earnings over the course of the season kind of fell in line with what you were expecting over at Moody's. Deposit growth supporting some of the funding, regional banks, which we continue to get a few more of here, kind of showing the CRE loan modification surging as well. But on the consumer front, what were we able to extrapolate from all of these earnings reports about the health of the consumer from your perspective?
We think delinquencies are peaking, meaning that you're going to start to see improved profitability with lower charge-offs over the next couple of quarters. Interest rates are changing, and whenever you have a transition like that, you're going to have some challenges to deal with. And in the immediate term, net interest income for the banks is going to be a bit challenged because deposits were still repricing upwards, and they will be able to reprice those deposits slower on the way down, whereas the assets are going to reprice much faster on the way down. So we are in a period where for the next couple of quarters, you're going to have lower net interest income on a sequential basis, but then that will be improved over the rest of 2025. So on the consumer side, you have low to moderate income renters who are going to have more challenges than, especially dealing with inflation, than consumers that are more in the higher net worth category or cohort, especially homeowners.
Fadi, what do you think is the biggest risk, given there's a lot to be optimistic about, especially as you look into the second half maybe of 2025, but what is the biggest risk that you think investors still need to keep in mind, given the fact that maybe we could see some near-term pressure on net interest margins?
Look, I think banks are in a much stronger position than they were a year ago. There could always be surprises, whether it's short-term volatility that happens. And we think when volatility rises in the market, large banks with capital market activities are going to be able to intermediate liquidity and benefit from these things. And sometimes you're going to have a surprise here and there, and having a strong capital position is always going to help. And we did see banks build up capital. We saw liquidity and funding improving. And with lower interest rates, there's going to be less pressure on the banks to pay these depositors more, because the depositors are going to have less alternatives in terms of money market funds as another option than deposits.
Fadi, just lastly, while we have you here, what do the banks and the earnings that we've heard thus far tell you about the state of buildup within mergers and acquisitions, and how that may look once we get post-election and into 2025?
I think we heard from the calls that there are some green shoots that these bank CEOs have been talking about for a long time, starting to actually sprout, and M&A results showed that. I think corporate CEOs are sitting on a lot of cash because there was some uncertainty. And every time you have this type of transition, whether it's US elections, whether it's changing the interest rate, you're going to have some hesitation in terms of pulling the trigger on an M&A deal. But things are starting to get more clarity. Corporate CEOs are having more, being a foresight on where the direction of interest rates are going to be. So I think that's going to be top of mind for the investors there.
All right, Fadi Masi of Moody's, thanks so much for taking the time to join us here this morning. Coming up next, we've got the opening bell on Wall Street, just about 3 minutes away. We've got that for you when we come back.
Just seconds away from the opening bell here on this Friday, or Friday for anybody who celebrates it that way. You've got a good look at the opening bells at the NYSE and at the NASDAQ. Clean core ringing the opening bell on Wall Street. And at Midtown Manhattan, where you got to spin move a couple Elmos and a couple Big Birds in order to get into the NASDAQ. There you've got Camp 4, the agile folks making their way in, getting some funfetti as a reward. All right, let's take a look at the way that the opening goes here, the opening cross here. We're taking a look at the Dow Jones Industrial Average as things are calibrating here on the Wi-Fi Interactive. That right now is just flat, just barely to the downside here. We'll see if that can make up its mind as we go on throughout the rest of today's trading activity. But as of right now, flat, just barely to the downside and in the red. The S&P 500, let's tee that one up here for you. That right now holding on to some fractional gains. It's up by about 0.3%. And the NASDAQ Composite, let's take a look at that. Just after the open, you're seeing the tech-heavy average holding on to some slight gains there as well. Let's get on over to some heat maps and get you a quick look at where the S&P 500, the 11 sectors, we've got them loaded up here for you on the screen as of right now. Pulling up the caboose, utilities right now, it's down by about 0.2%. But hey, let's give you some context to this chart. Why not? It's up 28% year to date. Also taking a look at XLC Communication Services. Ooh, that's catching a little bit of a bid here on the day. We'll call it a biddy bid. It's up by about 0.75%. And year to date, you can see that move to the upside by about 25%. Ultimately, it's somewhat split. You got 4 decliners as of right now. We'll see where things continue to transpire as we move on throughout the rest of today's trading activity. Just keeping it in that same realm or the theme of the check-in on some of the major averages and the components here that make them up. The Dow Jones Industrial Average, the 30 components, we've got them loaded up here for you on the screen. We were breaking down the earnings from American Express here. Ultimately, yeah, looking good year to date, but this is the number that you should focus on for today. It's pulling back a little bit after earnings by about 4%. We were breaking down some of those results a moment ago. Also, taking a look at some of those mega cap tech stocks that are in the Dow right now. You've got Apple moving higher by about 1.2%, Microsoft fractionally higher. And since we mentioned mega cap tech, let's take a look at NASDAQ, the NASDAQ 100. You're seeing it seems like even mix, just on some mental math and visual calculation here. But all things considered as of right now. And actually, you know what? Let's just put this on a different view. We'll just put it on equal. That way you can get it is actually pretty much an even split. But anyway, taking a look at Netflix here after earnings, ripping to the upside. It's up by about 8.25%. We were breaking down some of those results. Let's try this one more time. And if it doesn't work, then we'll give up. But guess what? It did. It's up 52% year to date and moving higher here after earnings by about 8%. If you haven't listened to our conversation with Jason Bazinet, just go on the Yahoo Finance platform and Google it. Well, Yahoo it. Look it up. All right, Shauna, over to you.
All right, Brad. Well, it's time now for today's strategy session. Big tech leading the S&P 500 to a fresh record this week. But is there a regime change underway as we see some outperformance of small caps? Russell 2000 moving to the upside this week. We want to bring in Michael O'Rourke. He's Jones Trading Chief Market Strategist. And Michael, I think many investors out there are trying to figure out what exactly is ahead for small caps. We certainly have seen maybe a bit of renewed optimism, although maybe some of that poured some cold water on it. The fact that we don't know what the Fed is going to do next, or that there's so much debate about whether or not the Fed should move at the next meeting. What does this all ultimately mean for small caps?
Well, small caps have underperformed for a couple of years. And, we had this June CPI report released in mid-July where we saw inflation start to cool. So that was the first sign that, the interest rate environment was going to free up for these small cap names and that the Fed was likely going to pivot. Now we know the Fed has pivoted, they cut rates, but they also came out with an extremely dovish outlook, regardless of the fact that we have a pretty strong economy right now. Q3 GDP looks like it's going to be above 3%. So that all plays to the small cap rotation. Basically, in the high interest rate environment, you saw a lot of investors flock to the Mag 7 names because they had size and safety. And of course, they weren't impaired by the high interest rate environment. But now that we're in this new easing cycle, you're seeing that rally broaden out, and it's benefiting both small caps and mid caps, and also the other 493 names in the S&P 500.
Should even within small caps, investors be focusing in on profitability among those small caps and thinking about the difference between the S&P 600, for instance, versus the Russell 2000?
That's a fantastic question. Yes. The Russell 2000 is an index comprised to just represent the U.S. Small cap market, all stocks with, just certain criteria as far as size, whereas the S&P 600 is a little more selective, and things like profitability and measures like that come into play. So historically, the S&P 600 has generally outperformed the Russell 2000. So if you want profitability and key metrics like that, you go to the S&P 600. If you just want exposure to small caps, you'd buy the Russell 2000.
Michael, what do you think the road ahead looks like for big tech names for Mag 7? We've got Tesla set to report next week. We've seen the growth estimates at least lowered just a bit on a quarter-over-quarter basis. How worrisome is that to the overall market, or is it not?
Well, I think because we have this rotation going on, it's not as worrisome as it normally would be. Right now, collectively, the Mag 7 are trading north of 40 times earnings, or double the PE multiple of the other 493 names in the S&P 500. So obviously valuations are expensive there, and the market has relied on them for the past 2 years to power the indexes forward. Now, if we're getting this broadening rally here, that the smaller names and in the or the other 493 names in the S&P 500 can actually support the index as those flows rotate into those names. So you can see a situation where even if we get underperformance from the mega cap names, that the S&P 500 itself holds up.
And so all these things considered, as we're mid-earnings season, of course, there are going to be a lot of different fluctuations within the S&P as we get even more into the depth and the teeth of earnings season. What do you anticipate might be the theme that we see play out among those companies within the S&P 500 that are trying to say, okay, AI trade aside, we can still show profitability and we could still forecast growth in this near term?
Yeah, I mean, I think the challenge or the headwind for the mega cap names or the Mag 7 names is expectations are really high for these names. So, you guys were just talking about the banks, where that's a group that's underperformed in the high interest rate environment. So, and that's an area that's benefiting from this rotation now, because again, the Fed's easing cycle is going to benefit them. It's going to benefit the assets they have on their balance sheets that have been impaired or marked down or have marked to market losses due to a high interest rate environment. It's going to help them from a funding standpoint, as far as deposits won't be fleeing. So I think that's you're looking for those groups in those sectors where tailwinds are starting to emerge. Whereas I do think with the big cap tech names and the mega cap leadership, there's just a lot of high expectations there, and they're great companies and they always tend to perform well. But again, it's just a very crowded group right now.
Michael O'Rourke of Jones Trading, thanks so much for taking the time here on this Friday, Michael. Appreciate it.
Thank you.
It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at some of the betting odds and politics within the market. Maddie.
Thanks so much, Brad. So when I talk to investors, they say that they got predicted up all day long on their screens right alongside the major averages. And betting markets through predicted are starting to show a lead for Trump. Take a look at the chart behind me. We've got Trump is purple here on this screen and Harris is the blue. You can see that divergence here. We can see these bets on platforms like Kalshi, Polymarket, and Predicted showing Trump in the lead. Now that is in contrast to polls like the Times National Poll Tracker that's showing a 2% lead for Harris. Proponents are saying that prediction markets, they move faster than the polls, so they give you kind of a better sense of what's going on here. But critics say that just a few big investors can shift these betting odds really quickly through big bets. So either way, with this move here, the so-called Trump trade has come back a bit. We've got Bitcoin, DJT, small caps, even the 10-year yield, all of these assets that some investors have said are driven up by market pricing in a Trump win here, moving to the upside. Now, some guests have said, don't worry about playing either candidate because Congress will be the true determiner of policy. But Jason Furman, we've got him on in the 10 a.m. hour. He points out that there's a 2/3 chance of Trump getting a red sweep, but only about a 1/3 chance of Harris getting a blue wave. And B of A's Michael Hartnett out with a note saying that bank stocks, small caps, and the dollar, they're front-running the 2016 bull moves that saw those same asset classes moving to the upside when Trump won back in 2016. And now a lot of these asset classes are also driven by the macro. We've talked to plenty of sources on both of our shows who've spoken about the macro outweighing the fiscal, but nonetheless, Wall Street is starting to prepare for what these prediction markets are showing, which in this case is a higher chance of a Trump presidency.
All right, Maddie, thanks so much for breaking that down. Of course, we're going to continue this conversation, maybe focus on the policies and the implications of that, what it ultimately means for investors with Jason Furman. Again, he's joining Maddie and I next hour. That's coming up on Catalyst. Coming up next here on Morning Brief, the best bromance in tech. We're taking a closer look at the relationship, perhaps not, between Microsoft and OpenAI. We've got that next for you on Morning Brief.
Finances can be a major source of strain in any relationship, and hey, big tech's no different. According to the Wall Street Journal, OpenAI and Microsoft have hired outside counsel for advice on how much the tech giant will get in equity for its nearly $14 billion investment in the startup behind ChatGPT as it transitions to a for-profit corporation.
Well, Microsoft initially invested $1 billion in OpenAI back in 2019. The startup agreed to an exclusive deal with the tech giant. In exchange for a close collaboration on new AI, Microsoft would provide cloud computing power. But the relationship, which OpenAI CEO Sam Altman once called the best bromance in tech, has faced some road bumps. For one, the startup has been burning through cash. It expects to lose about $5 billion this year alone. And last November, the company's board briefly ousted Altman, saying that he had not been, quote, consistently candid in his communications. Altman was reinstated less than a week later.
That shakeup shocked and concerned Microsoft CEO Satya Nadella, according to reporting from the New York Times. And Microsoft hit the pause button on funding to the startup. Executives also became concerned its AI initiatives were too dependent on OpenAI. Since then, Microsoft has begun exploring alternate sources of AI power, hiring most of the staff from OpenAI competitor Inflection. OpenAI has also found new partners, striking a deal earlier this year to integrate ChatGPT into Apple's system.
Let's dig into OpenAI Microsoft relationship and speak with someone invested in one of its biggest competitors. We want to bring in Santosh Rao. He's the head of research at Manhattan Ventures Partners. It's a firm focused on pre-IPO companies and an investor in OpenAI competitor Anthropic. Santosh, my question to you is just in terms of what this could mean for funding, this back and forth. It seems like every week we're getting some sort of update on the relationship between Microsoft and OpenAI. How much does that matter for future funding?
Well, I think you're going to see a lot of this back and forth going on because this whole space is really developing. I mean, so these things is not out of the realm of possibilities. But I don't think, in the end, it's too huge a market, too important a technology to get it into their system, into their ecosystem. So there will be compromises, there will be some arrangement, but at the end of the day, you're going to see this because it's a high stakes game going on in the AI. So these kinds of battles do happen, especially in the initial stages that we are in. So let's see where it goes, but I don't see that as any limiting factor in terms of the growth of the space.
Are you alarmed at all by the rate of cash burn that you're seeing in the space, though?
Absolutely. I think that has become a big concern. The companies have invested a lot. There is no return on investment. I think that's become a big concern. Nobody's making money right now, except for NVIDIA. So I think that's a huge issue in this AI space. Down the road, you will get that, but you need this massive investment. These are very expensive models that you need to feed and nurture and grow them. So it's going to take a while. In the end, it'll pay off, but initially it's going to require tremendous investment, which you're seeing. And investors are worried that is there enough return on all the investment that they're making?
What do you see as the revenue model, the monetization? Because for search, at least, people have been so accustomed to free search for decades now.
Yeah, so I think that's also taking shape now. We don't know yet what it'll exactly take, which form it'll take. I think subscription model makes sense, but at this point we don't know how you're going to monetize this whole space. But I think let's wait and see. I've heard different variations of how they will monetize in the end, but at this point, it looks like subscription might be the easy one. That's easy to call, but down the road, let's see. You have freemium models and this and that. There's so many ways you can go about it initially till you get people into the system. So let's see how it plays out, but it's still early days there.
Santosh, what does the IPO roadmap then look like for so many of these companies? We had the headlines out over the last 24 hours that after they rejected Google's takeover, Wiz, the cyber firm, saying that it's going to IPO when, quote, the stars align. What do you think that looks like for these companies that have been waiting on the sidelines?
Have been on the sidelines, yes. The IPO market is on hold. I think it's at the cusp of coming out. There's some limiting factors. The volatility is very high, so price discovery becomes a big issue for IPO companies. So I think you're going to wait and see post-election. The number of companies waiting in the wings. In fact, the last I checked, there's some 200 plus companies that have not done last funding round, in the last 2 years, rather. So there is a need for companies. There's a lot of pent-up need to get out there and go public. The investors are also will get. I don't have any data on that, but will understandably get a little antsy on going out and getting their money back. So that's a huge issue for venture capital money. That money needs to come back. You need that return. So the exits have not been very wide, very deep. So we need that window to open wide. But I think in terms of timeline, looking at from today's vantage point, looks like 2025 has been, the timeline has got pushed out to 2025. Few companies will come out. Cerebras has come out. That'll be a very interesting tell on whether the market is ready for a company that's high growth, not profitable, but has tremendous momentum. It's in the right place at the right time, though it has some issues. NVIDIA is, of course, the undisputed champ there, but there are some other companies coming up also in terms of inferencing and other areas. In the training side, of course, NVIDIA is the leader, but on the inferencing side, there are a number of competitors in the niche markets that are coming up. So they will come up, a lot more competition coming up down the road. So 2025, in terms of the IPO market itself, I think 2025 looks like a sweet spot where the election will be behind you, volatility will kind of hopefully subside, interest rate will have better clarity in terms of the economy. So it looks like the stage will be set in 2025.
But will it be healthy companies that we see going public, or will it be companies that feel pressure to go public because of the funding that they've taken on and some of those dollars that they've received? Well, depending upon where they came from, they might be in the ear saying, hey, we'd like to see some of that return realized right now.
I don't think the market's going to give any leeway for companies that are not profitable or are not close to profitabilities. I think we saw what happened last time. Number of investors got burnt. A lot of companies stumbled at the gate that were high growth, no profits, profits in the future, way in the future, things like that. So all those companies got punished. So pretty much it became like almost a necessity that you had to have a solid business model and not too many doubts. So the investors gave you the benefit of doubt, but only up to a certain point. So I think that you're going to see that. But the companies waiting in the wings that we are talking about, that I follow very closely, they are very good company, very scaled companies, very mature companies. They're ready to come out in one way or the other, but they can wait. They have money in the bank. So they're going to be selective. They're not in a rush, but they don't want to be the first one out and without any, they don't want to just ride out the euphoria. They need to have something behind it. We have seen that in the past, did not work. It has to be solid company with a solid business plan, business model, proof of concept and everything, and that will succeed down the road.
Santosh, thanks so much for taking the time here this morning. Head of research over at Manhattan Venture Partners. We understand you're out in Princeton, so grab some pancakes at PJ's for me, why don't you? Appreciate it.
Okay, definitely.
Right,
Take care.
Coming up, everyone, trending tickers. We're talking about 3 stocks, and we're doing it in 30 seconds or less. What? Who put that in there? Yeah, we do it every day. We'll bring you the latest news on Apple, Tesla, Intel after the break. Stay tuned. We're taking a closer look at some trending tickers this morning. We've got Apple, Tesla, and Intel, and we're doing it in 30 seconds each or less. Let's go. Sales of the newest iPhone 16 lineup in China, they're up 20% in its debut 3 weeks in compared to the 2023 model. Now, that's according to Counterpoint research data provided to Bloomberg. Take a look at shares of Apple AAPL. It's up by about 1.4%. And we had actually got an update earlier this week as well from IDC talking about the growth in China. Specifically here, what's notable is that the growth in Chinese players in emerging markets, that's been an ongoing theme this year. Apple also enjoying a 3.5% year-over-year growth in shipments this quarter, fueled by the demand for that iPhone 16.
All right, turning now to Tesla, the National Highway Traffic Safety Administration has opened an investigation into Tesla's full self-driving software. This follows 4 crash reports involving 1 death and 1 injury. An NHTSA spokesperson telling Yahoo Finance that the probe will examine the system's potential failure to detect and disengage in specific situations where it cannot adequately operate and the extent to which it can act to reduce risk. Of course, this has been a question here surrounding Tesla. Big question for investors, obviously beyond safety, is ultimately how big of a drag potentially this could be on Tesla stock.
Absolutely. And lastly here, we've got to check in on Intel. Intel is reportedly looking to sell a minority stake in its Altera unit in order to raise billions of dollars. It comes as Intel struggles to keep up in the AI race as it's spending heavily but losing some significant market share to chip makers who are out in front like NVIDIA and AMD. Shares right now, they're up by about 1% as this would be roughly estimated, or it is believed to be about a $17 billion sale that they're eyeing here.
That does it for this morning's Morning Brief. Join me and my co-host Madison Mills the next hour. We've got a lot more analysis on the catalyst. We'll also be speaking with Jason Furman coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills, 30 minutes into the U.S. trading day. And let's get to the three catalysts that we're watching here this morning.
First up, full earnings coverage ahead as Netflix tops estimates on all metrics. We'll break down what the advertising picture looks like and whether it could boost prices for that tier.
Plus, we push ahead to Magnificent Seven results kicking off next week. Can the reports drive big tech to continue its rally, or will a rotation continue?
And with just 17 days until the presidential election, we'll sit down with former Council of Economics Advisor Director Jason Furman to break down the policy implications that could impact your portfolio.
Russell 2000 on track to end the week with gains up just about 2% in the last 5 trading days. And as earnings season chugs along, can the small cap trade keep up the momentum ahead of Mag 7 results next week? We want to bring in Mike Reynolds. He's the Vice President of Investment Strategy at Glenmead. Mike, it's great to have you back here. So let's talk about this bit of a rotation, if we want to call it that, maybe this week. We did see small caps get a bit of a boost. You see that in the outperformance of the Russell 2000. Yet we have seen many of the names that had outperformed, namely NVIDIA, continuing to outpace the broader market. What do you make of that move higher, and who will be, or what will likely be, the leader here as we enter the thick of earnings season?
Yeah, thanks for having me on. It doesn't surprise us at all to see small cap getting their day, or really their week. We see three big catalysts for small caps that are just really big tailwinds for them right now. We've got the combination of fair valuations, really rosy earnings prospects, and favorable exposure to the Fed cutting cycle, where you see small caps typically do pretty well once the Fed pulls back on rates. We don't think this is a short-term phenomenon. We think that this rally has some legs to it as we see this internal rotation favoring small caps, value stocks, investment processes that are a little bit more diversified in nature. So we think this is a trend that's here to stay.
You're saying it's a trend that's here to stay, but I'm curious for investors who feel perhaps that they have missed the start of this rotation. Is there still room for them to get in here? And if so, what is the best way for an investor who hasn't taken advantage of the rotation to start to play it?
Just take a look at the valuations. I mean, by our estimates, we're now basically right at fair value for small caps. You compare that to large caps, sit around the 75th to 80th percentile. And that suggests to us that there is still room for small caps to run here. When you have such a large valuation differential between those two classes, it's a process that will see convergence over time. And so, but from our opinion, that's something that's going to continue to develop through the end of this year and perhaps even into next.
Mike, how much of that hinges on continuous rate cuts from the Fed?
A good amount of it does. And look, our opinion is the Fed's going to get rates to the neighborhood of neutral by, call it, the mid of 2025. This is important for small caps because a larger share of their debt is floating rate. So they're going to be more directly rate sensitive to where the Fed is taking things. That's a big part of this rotation, in our opinion. And if there's a wrench that gets thrown into that process, maybe you can see some hiccups here. But the bigger picture is that the Fed is going to be going in this direction. Maybe the question is just how fast and exactly what that process looks like. But from our perspective, this is a pretty meaningful tailwind for small caps.
Have you already seen small caps refinancing? And if so, what will be the next big catalyst to push even more of that activity? Are they going to wait until Fed is closer to neutral rate, or will they already start to pick up on that activity here?
Well, since a good amount of their debt is floating rate, they almost don't have to. It sort of takes care of itself. But we are seeing some incremental signs of that from businesses. You're actually seeing it a good amount from consumers as well. Refi activity on mortgages is up a good amount. So people are seeing some interest rates that they haven't seen for quite some time and starting to look at what makes sense here, and in a lot of cases starting to act on that. We may see more of that as we go into next year and rates continue to fall.
Mike, where does all this leave big tech ahead of the kickoff to their earnings results next week?
Yeah, so next week's a big one for big tech, and we have a heavy focus on the Mag 7. In our opinion, Q3 might actually look pretty magnificent for the Magnificent 7. So an estimated 17% earnings growth for that cohort of companies compared to 1% for the rest of the index. Now, markets are going to be forward-looking here. As soon as we get those reports, it's going to sort of be old news. They're going to start looking toward Q4, where estimates are actually a bit more in line between the Mag 7 and the rest of the index. As earnings growth is looking like it's going to get more plentiful going forward, which again should be a tailwind for those investment processes that follow a more diversified approach.
Speaking specifically about the Mag 7, we've had a lot of investors on the show talking about how there have been earnings revisions to the downside for a lot of different sectors, but not necessarily to as much of a degree in tech specifically. How concerned are you about earnings expectations for tech being too elevated still this quarter?
Not that worried about it. We're seeing some pretty reasonable earnings estimates, and the expectation that it's still going to be a relatively narrowly driven quarter on earnings. And if you look at dispersion numbers, you may not get full participation from the tech space. But again, the Mag 7 is really just delivering that magnificent growth. And the question is, when does that sort of broaden out? And again, we're looking at Q4 there.
Mike, what do you think is the biggest threat to the market's recent momentum? Here we are. We had record highs once again this week. There's a lot to like, a lot to be encouraged about, like you're talking about, just in terms of the rotation, the holding up here that we're expected to see from some of the big tech giants for earnings season. What, though, do investors maybe is flying under the radar that they need to be paying closer attention to?
Our biggest risk right now from our perspective is inflation reacceleration. So we saw a CPI report just a month ago that I would characterize as continuing the process of inflation normalization, but there were some signs underneath that we need to watch this a little more closely going forward. A good example is core services, which came in a little hot. Now that's a sticky part of the basket that you got to sort of watch to make sure that doesn't get out of hand. We don't think that the inflation is going to reaccelerate back to 2022 levels. That's certainly not our base case, but the likelihood that we could see a bit of an acceleration here is non-zero. And what that does is it throws a wrench into the Fed's rate cut process and plans. So it's something to watch going forward, but again, not our base case that that's going to disrupt the Fed's rate cut campaign.
Mike, I want to ask you about something I brought up in our chart of the day earlier, which is what we're seeing in predicted markets with Trump having higher odds of winning the presidential election than Harris, at least according to the betting market side of things. Small caps are getting lumped into the so-called Trump trade as a potential beneficiary of Trump entering the White House again come November. Do you agree with that correlation?
There's a little bit of a difference between correlation and causation here. We think there's just a couple different cross currents affecting the markets right now, and the election is certainly one of those. Look, we're talking to our clients about the election, and the main takeaway is often it doesn't really matter which party occupies the White House. Market returns are actually pretty similar. If you go back to basically right after the Civil War, there's almost no difference between Republican and Democrat administrations for small caps, for large caps, whatever you want to call it. But what we can prepare our investors for is heightened volatility around the election, especially this year when you have two candidates who have pretty disparate proposals on the political spectrum. This could be a contributor to volatility, especially, if we don't know the results right away and there's a good amount of uncertainty on the direction of policy for the next 4 years.
All right, Mike, we got to leave it there. Thanks so much for joining us. Appreciate it. It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Bridgewater Associates onshore China hedge fund adding exposure to local stocks following last month's rally that boosted the fund's returns to 31% for the year. The firm saying the valuations do remain attractive. The fund is also long on bonds and holds a neutral stance on commodities as of September 30th here. But this is interesting given the moderate increase to its holdings in China following the excessive stimulus that we have seen coming out of the region. But the big question, I think, is whether or not this is going to be a sugar high that leads to a little bit of a positive lift for capital markets. But is that going to feed through to consumers? And that's the final thing that's really going to be needed for there to be a continued lift to Chinese stocks, not only because of this, not only stocks that are in the region, but of course stocks that are trading in the U.S. as well.
Yeah, of course. And that's what you and I have been talking about now for what feels like a very, very long time, just in terms of the stark underperformance of China's economy, what it would take in order to reignite or reintroduce some of that lost enthusiasm. Yes, we have seen stimulus moves or stimulus efforts from the Chinese government. But again, the question is whether or not it's enough. It doesn't sound like it is enough from consensus. I think that would be pretty much the takeaway at this point. And then ultimately what is necessary in order to continue this move to the upside and this outperformance. We know that Bridgewater Associates with Ray Dalio, a longtime China bull there. So again, he has seen opportunity within this this area, but I think in terms of what is going to be that ultimate catalyst going forward, Akiko, our colleague, has been doing a great reporting on this, and very much it seems like the question is out and the jury is out just in terms of what ultimately is necessary. There is more that is necessary, but what it's going to take in order to really see continued momentum in the region. We will also hear from Karen Karanal at Tambor. She's a Bridgewater Associates Co-Chief Investment Officer at Yahoo Finance Invest. That's happening November 12th. You won't want to miss that. Coming up, we sit down with former Council of Economic Advisors Director Jason Furman to talk all things economic policy ahead of the November election. Stay tuned. You're watching Catalysts. By recent metrics, the U.S. economy could be doing just fine. Strong retail sales numbers in September signaling a resilient consumer, while lower than expected jobless claims helping to ease some of the fears surrounding unemployment. The latest data coming after the Fed went big and cut by 50 basis points at its meeting last month. The reason for that move? Worry about a sluggish jobs market. Larry Summers, former Treasury Secretary under the Clinton administration, calling that jumbo cut, quote, a mistake, pointing to September's blowout jobs print. We want to bring in Jason Furman. He's Harvard Kennedy's School of Government professor and former chairman of the Council of Economic Advisors under President Obama. Jason, it's great to have you back on Yahoo Finance. Thanks so much for taking the time.
Sure. So
let's start with Summers' comments. We know hindsight is always 2020, but there has been a lot of talk about whether or not the Fed maybe went a little bit too big in September. Is there some truth to what Summers is saying, or do you think the Fed made the right call?
Look, I was in favor of 25 in advance of that call, but I didn't think it was a big deal. rates were and still are higher than they need to be. Even though I don't think inflation is fully licked, it's much lower than it was a year ago. So rates should be lower than they were a year ago. And if you get started with 50, get started with 25, not a big difference. Really depends where you end up.
So Jason, what do you think is the more likely risk for inflation? A reignition, more heat in the economy, or the potential that, dare I say, inflation was transitory?
I think, inflation to me looks poised around 2.5%. And it could be a bit higher than that, which would be a problem for the Fed, or a bit lower than that, which would be completely fine for the Fed. But I do think at this point, the inflation risk is larger than the recession risk. And so the Fed needs to have tight policy. It just doesn't need to have policy being as tight as it was last year.
Is it bigger than the risk of what we're seeing in terms of the rise of unemployment, or maybe the sluggish labor market growth? And I guess beyond that, what could that ultimately mean, the fallout then for the economy?
Yeah, we have a 4.1% unemployment rate. If the unemployment rate could stay there forever, I think we'd all be pretty happy. And you saw, as you mentioned in your opener there, you had that great jobs report. UI claims look fine. And other parts of the economy, like consumer spending, GDP growth, we might get another 3 handle for a second quarter in a row. When we get the numbers later this month. So we have a lot of demand in this economy still. It's a very strong economy. Need to just keep tamping down on the inflation.
It's interesting, Jason, because historically politicians have focused on making sure unemployment is as low as possible, and the Fed's job has been to make sure that any fiscal policies don't spur too much inflation. It seems to me the past 4 years we kind of seen the opposite. Consumers really don't like inflation and don't seem too happy about the unemployment rate staying too low. What does that tell you about consumers, and what might that mean for the relationship of fiscal and monetary policy moving forward?
Look, we've gotten a good reminder about just how much people hate inflation, something that people who weren't around in the early 80s or paying attention in the early 80s hadn't fully realized. So in one sense, it's a scarring experience. But it is also the case that fiscal policymakers, any given decision, they're thinking more about who gets the direct benefits of the money than they are what does it mean economy-wide for inflation. So even though they don't like inflation, they like whatever goodie they're handing out to whoever they're handing out, even more than the inflationary impact. So I don't think fiscal policymakers can be really counted on or relied on to bring inflation down. Needs to continue to be the central bank that maintains that discipline.
Jason, real quick, before we move on to some of the economic policies from the presidential candidates, how confident are you today that we're going to see that soft landing?
I think the odds of it are higher than they've ever been, but we're still not there. I'd like to see, something like inflation less than 2.5% over a 12-month period. And, you see continued strong wage growth, which is a wonderful thing. My hope is that's just workers catching up for all their losses and that it won't actually be inflationary, but you never know. So yeah, chance of soft landing higher than they've been, but still can't make the call.
All right, Jason, let's talk about some of the economic policies laid out by both former President Trump and Vice President Kamala Harris. Both candidates have laid out varying policies with a similar bottom line. There's going to be a bit more spending. Earlier this month, we had a chance to speak with Gary Coney. He joins us on Sept, the former director of the U.S. Economic Council under former President Trump. And Jason, I want to play what he had to say about growing the U.S. economy and then get your reaction on the other side.
I happen to like the pro-growth, the reasonable but sensible regulatory economy that we had during the Trump administration. I think this overly protective, overly restrictive, highly regulatory economy that the Biden-Harris administration has is not beneficial to growing GDP.
All right, Jason, I know your view probably differs just a little bit. You had an op-ed in the Journal not too long ago saying Vice President Harris is a safer economic choice. What's the biggest threat, do you think, from former President Trump?
Yeah, first of all, by the way, it's not just me that disagrees with what Gary Cohn said. The stock market disagrees as well. It's gone to new heights, extraordinary growth. And, there's some regulations I've seen that I don't like, some that I do like. But on balance, they're just not killing the economy. Going forward, I think it's Donald Trump who does pose quite a risk to the economy. If he follows through on his across-the-board tariffs, He's talked about 10%. He got criticism. He changed it to 20. Recently mentioned 50. That just would unleash a trade war, shrink exports, shrink imports, raise prices, lower jobs. Terrible idea. The Fed, I don't think he can undo and destroy it in a 4-year period of time, but him plus a successor in 8 years, maybe could. And it's such an incredibly important institution. I would not want to take any chances with it. And finally, on the budget, just about every analysis that I have seen, nonpartisan ones, even conservative ones, have found that Donald Trump's plans would spend considerably more than Harris's would. And by the way, they're not pro-growth, exempting overtime pay plus Social Security benefits plus tips, et cetera. That's not the way to have a broad tax base with low tax rates to foster economic growth.
Jason, at least when you look at some of the betting markets, it does seem like the market is optimistically pricing in a potential Trump presidency. What do you think the market is missing if there is kind of some optimism under the hood and outwardly from certain high value members of Wall Street talking about how they are excited to vote for Trump come November?
Yeah, I'm a big believer in betting markets. I think they're a great way to aggregate and share information. They have moved more in the direction of Trump than I fully understand. The polls have moved a little bit in his direction in the last week or two. The betting markets even more so. So I don't fully understand that. But I think more importantly, there's a lot of businesses who think he doesn't mean what he says on tariffs, on immigration, on government spending, on the Fed, and they might be right. But do I think there's a 20% risk that he'll do what he says? Yes. Do I think a 20% risk times a rather large event for the economy is something that goes way beyond a tail risk and is worth paying attention to? Yes, I do.
I also want to get your thoughts on Harris's potential policies that could impact the economy. And one of her focuses is on price gouging. What do you think is the potential negative outcome that could come from any policy on price gouging?
Look, I was critical of her when she first announced that policy. It's since been either redefined or maybe clarified. I'm not sure what it was originally, that this is basically the same thing states do in extreme emergencies, like a massive hurricane in the days after it. You can't have dramatic price increases. I think there's arguments for and against that. I don't think it probably is something the federal government should or needs to do, but it's not economy-wide price controls that some originally feared. And by the way, there were some supporters of hers that were hoping it was that too. So I don't think that's a central plan for her. It's certainly not going to pass. It would require 60 votes in the Senate. Things like the child tax credit, I think, are nearer and dearer to her heart. And by the way, I think would be a good idea to have in our country.
Jason, talking about the fact that both candidates will be adding to the deficit, of course, estimates are out there. And like you said, former President Trump is expected, his plans or policies, what has been laid out, expected to add a couple trillion more than maybe Harris. At this point, neither side seems to care. Neither side seems to be addressing the spending. And that has gone on for years. From your time with the former administration, with the former Obama administration, what do you think it's going to take in order for either side to address this pretty serious threat to the economy?
Yeah, so look, I think there's differences between the two sides on this, but neither side is what I'd like to see in terms of taking this seriously. And what do I think will change? I mean, first of all, markets could make a change. If you see interest rates start to go up, you had a Liz Truss moment in the UK where interest rates spiked. Could somebody introduce a fiscal plan and it would cause something like that in the United States? Maybe that'll happen one day. There's also some forcing events in the political system. Social Security and Medicare trust funds are exhausted in about a decade. They can't afford to pay full benefits after that. I'd love to see that as a motivation for policymakers to act. And by the way, that doesn't mean to act a decade from now. It means to act as quickly as possible to forestall that what would otherwise be a terrible event.
Jason, as we get to the end of our conversation, I just think about our audience and those out there who are still deciding who they're going to vote for come November. Can you give us one big takeaway for the economic impact of both Trump and Harris that our audience members should keep in mind when they're thinking about the economic impact of whoever ends up winning that election?
Yeah, so Harris is largely a continuation of what we've seen in the last few years, but I expect her to be a bit more moderate. And by the way, we've had very strong growth, job growth, U.S. economy, envy of the world. With Donald Trump, you're really taking your chances. The Donald Trump of the first term did some good things economically, did some bad things economically, but wasn't incredibly risky. The thing he's talking about on the campaign trail would be extremely risky. And, I'd be worried that he actually is telling us the truth.
Yeah, Jason, what do you make of that disconnect? It kind of mirrors what I asked you about Wall Street pricing in some optimism around Trump presidency 2.0, I guess. What do you make of the disconnect for some voters who don't see it the way that you do? Where do you think that their optimism about a Trump presidency is coming from?
Look, first of all, it's on an important set of issues that aren't related to the economy, and you could, based on your values and preferences, decide between these two candidates. But yeah, I think there's a lot of people, and certainly I hear this in the business community for sure, who just discount it. They think Trump says these things and is not going to do them. And they may be right, but they also may be wrong. And
do we
I
have
would
evidence of that,
take my
Jason?
chances with 20% tariffs.
Do we have evidence of that, Jason?
It's what you see in the market. If the market truly believed he was going to do 10 or 20% across the board tariffs, and he had a 60% chance of winning, I don't think the stock market would be where it is today.
Interesting stuff. Jason, we really look forward to hopefully having you back again soon. Jason Furman, Harvard Kennedy School of Government professor and former White House Council of Economic Advisors chair. Thanks so much for taking the time to join us.
Thank you.
Coming up, we will take a look at some of today's trending stocks. We'll give you the news behind the moves that we're seeing. That's coming up next on Catalysts. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. That's with Yahoo Finance's trending tickers page. First up, Taiwan Semiconductor saying it's taking, quote, prompt action to ensure compliance after a report claimed that the U.S. is probing whether the chip maker is working with Chinese tech giant Huawei, which could violate U.S. export rules. The U.S. has banned Huawei from buying chips manufactured using American equipment since 2020. This, of course, goes back to the escalating tension between the U.S. and China. This crackdown, blaming it on national security concerns, very much tied to some of the export restrictions that we have seen play out during the Biden administration, and also going back to the ramped-up rhetoric during the Trump administration. But again, going forward, we are seeing a bit of a reaction on shares here this morning, Maddie, with the stock off just about 1%. Of course, this comes after yesterday's rally on the heels of that better than expected report and earnings report and guidance. But again, lots of questions following this report out from the information here this morning.
And TSMC coming out saying they're willing to take prompt action to ensure compliance off of this move from the Commerce Department. It's in its early stages. We should mention that the information does note that. So this could just be a question, right? Did you guys violate it? TSMC could clarify it, and then that could be the end of it. But if the investigation does reveal any sort of guilt on the part of TSMC, they could face fines or restrictions on further access to U.S. technology, which of course would be a further headwind to the stock moving forward here. And again, TSMC was a key supplier for Huawei back prior to 2020, before these U.S. rules were put into place. And following those rules, they were no longer part of their supply for Huawei, which is claimed to develop a similar chip in competition with TSMC directly. So interesting to see how that will continue to play out here. Well, Netflix shares are surging. The streaming giant's ad-supported subscription tier showing momentum in its third quarter earnings print. To discuss what the future of advertising looks like for Netflix and other streamers, we've got Mark Douglas here. He is the CEO of Mountain. Great insights on advertising strategies specifically here. So it's great to see you, Mark. I just wonder if you were to take a call from the CEO of Netflix after this interview we're about to have, what would you say is the single biggest strategy shift they should make when it comes to advertising?
Well, I think they're already making that strategy shift. So the move towards ad-supported customers is doing something very interesting to Netflix. It's essentially making it a growth stock and a value stock at the same time. The reason I say that is they're adding ad-supported customers at a significantly faster rate than they're monetizing them. So that's creating a big revenue backlog that they'll tap into in maybe 2 to 3 years, is essentially their ability to monetize catches up to the ability to attract those customers. And when they do that, essentially, I think that Netflix will become the first $1 trillion media stock. I mean, it's going to have a huge impact on their revenue.
Yeah, Mark, does that essentially put Netflix almost in more of a league of its own? We talk about the dominance already. Now that they're even separating themselves further with this ad platform and their plans there, I guess how much more of a leverage does this give Netflix in terms of some of those contracts, in terms of engagement, and then ultimately consumer growth?
Yeah, well, I think they're going to continue to have the natural consumer growth. They're also the best at streamer kind of internationally. So they're not only really good in the United States, but they're very good worldwide. And so, you know, when you combine that growth, which you're already getting, and you see investors responding really well to, and you combine that with this kind of backlog, which is similar to their password sharing backlog. You know, a few years ago, it was so easy to get into a Netflix account using your friend or family member's account. And then they just kind of slightly locked down on that and had an explosion of subscribers and explosion of revenue. This is essentially similar. You know, it's basically creating this revenue backlog that they'll tap into. Another way to think about it is you could predict that Netflix will do let's say a 2x price increase in 2 years, except the subscriber is not going to pay for it. The advertiser is. That's another way to kind of mentally wrap your head around it. And it's coming. The likelihood that's coming is, I would put it at nearly 100%.
Okay, so if the advertiser is going to pay for Netflix's growth, do they secretly not want us paying for the ad-free tier moving forward, especially as they do move into live sports? I've been trying to ask the sports people around me, like, can we have a football game without ads? And I just wonder how that impacts Netflix moving forward.
Yeah, I mean, that's the little secret in media, is that the advertiser media companies want you to like ads. They make so much more money. So if you think about it, even in what's now the old world of linear, you know, like Disney at one time was selling subscriptions. At the same time, they're getting like $7 per household. every household subscribed to cable. So they're and you might have cable and have a subscription. So they're kind of double dipping. So they love when you're in the ad-supported tier, not in the ad-free tier. It makes them a lot more money.
Mark, give us an inside scoop just within the media space, the conversations that you're having. Who is or what is the biggest threat, do you think, to Netflix's business today?
Well, I think it's Disney. I mean, Disney is clearly also a massive player. I think they're very seriously focused on streaming. They have the dominance in sports with ESPN. So I think Disney and Netflix are the pinnacles of streaming. Peacock, is up there, but not quite yet at the same level. But I think it's going to be kind of a new streaming war, but it's like the war of the giants, and Disney and Netflix are the two companies that, again, I think that Netflix for sure becomes $1 trillion stock in the next 36 months. And Disney could do that too. They just have more complexity in the business because of Disney parks and things like that, make it a little harder to value it.
I wonder then, not just kind of in the short term, but more long term, Mark, let's say we call you in 10 years, right? Is it still Netflix versus Disney, or do we start to have a conversation about something like Call Her Daddy being the main player in the media space and taking more market share away from those, I guess, what would then be traditional players?
Yeah, I mean, podcasting and alternative medium, you're increasingly seeing a lot of sports on YouTube. And those are definitely going to be big, alternatives. But the ability to consistently put out content that consumers want to watch for 2 to 3 hours a day, that content costs tens of millions to tens of millions of dollars to produce. That's like one category, and more organic content or alternative sports or things like that will be there also. And I think they'll both thrive. They're not real. One's not really going to take down the other. I don't see that happening because consumers love kind of their favorite shows produced by the best, literally, producers in the world.
Right. We can't lose Love is Blind, Mark. Thank you so much for joining us. Really appreciate it. Mark Douglas, Mountain's CEO. Well, coming up, options trading is increasingly popular. We're going to talk to Cboe's CEO about why traders are turning to the options market. That's next, right here on Catalysts.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator.
Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Options trading is on the rise, with the options market seeing 4 consecutive years of record volumes since 2020. Joining us now to discuss, we've got Fred Tomczyk, he's Cboe's CEO, and it's great to have you here, Fred. I'm curious, when you think about that bump up over the last 4 years, it kind of reminds me of the bump that retail trading in general had in 2020 when retail investors got access to a bunch of stimulus. What would you say to the idea that options volatility and trading in general is more of a retail trader's game versus the quote unquote smart money?
I don't think that's true. I think it's both if you look across the option market, it's still more institutional than retail. What's happened more recently is you've got a little increase in volatility, which is causing trading. You've got more expirations, so we've introduced products to give you expirations every day of the week, so that's increasing volume because it makes it more efficient to hedge risk around certain market events that you may be worried about. But it's also because the retail brokers have introduced option trading and education to help people get comfortable with them. So it's the whole ecosystem that basically is growing right now, and it's not unique to the U.S. It's happening around the world. There's a lot of option volumes in India and in different parts of the world. People are using them to hedge a risk, generate income, or place a speculative position on.
Is the options market still just in, not its infancy, but early stages, given the fact that we've had 4 years of record growth or record participation? You're saying that there's a lot to remain optimistic about. When we talk about why investors are turning to the options market, what do you think that activity then looks like over the next 3 to 5 years?
Well, we've had very strong growth the last 4 years. A large part of that's been driven by what's called zero DT, the multiple expirations. There's no question about that. It just gives people a better way to do things in the short term, and it makes it less expensive. So I think that growth will moderate somewhat, but I think it will continue because you just continue to see the adoption in the retail brokerage community by those clients on the use of options. So I suspect growth will continue, although it will moderate somewhat from what it's been the last 3 or 4 years.
Fred, what's next for those short-dated options? What do you think will be the next big ODTE trade?
Well, that's hard to call, but I would say there's lots of talk in the industry about single stock options trading in a zero DTE style. That's complicated for a lot of reasons in terms of physical settlement and the clearing systems and whatnot. So the industry needs to be careful with that to make sure the market's ready for that and the infrastructure is ready for that. But at some point in the future, I can see that happening. Whether that'll happen next year or not, I don't think so. I think it's going to take a bit of time for people to sort of work through the mechanics of that and build the necessary technology and infrastructure for that.
Fred, going back to the start of August when we saw that massive spike in volatility, when you take a look at some of the losses that day and those that were caught short-handed, I'm curious from your perspective, what was the biggest lesson you think investors or traders should have learned given that massive spike that we're seeing right there on our screen at the start of August?
Well, first off, if you're going to trade options, you have to stay on it. And what happened on August 5th was a unique event. Basically, when the Japanese market fell 12% overnight, the S&P 500 E-minis were trading down 5% pre-open. So you had a liquidity event where there was an unwinding of the Japanese carry yen, the yen-dollar carry trade. So we had a unique event with a lot of liquidity. So that did spike in that moment. But once the market opened and it normalized and came back, so sometimes you can just be patient and ride through that. In other cases, you need to stay on it. And in other cases, depending on your position, you don't want to leave it on overnight. So you want to close it down before you close for the night.
Given that, do you think that options trading is more of a avenue for gains for day traders than traditional, I don't want to say traditional investors, but more long-term dated investors? And what would you say to those investors who are like, this is just not for me. This is just way too time intensive.
I would tell you to take your education to learn how to trade options properly. And if you learn how to do it properly, you're going to start with generating income. You're going to sell covered calls, maybe cash covered puts. So you're just generating an extra yield on an existing portfolio. So that's the first place to start. And then if you're going to migrate up, you migrate into spreads and defined outcome trades. So when you place a trade on the option market, 2 lessons are always know your downside and make sure you're protected and you're comfortable with it. Secondly, if you're going to trade options, stay on it. It's not something you put on and forget like a stock for 5 years or so. You have to stay on it every day. If you do those two things, your odds of success improve significantly.
All right, Fred. Well, speaking of, that was great advice for some retail traders out there who maybe are thinking about exploring the options market. You're joining us from Robinhood Summit in Miami. I know it was an exciting announcement made during the summit that Cboe's index options will soon be available on that platform. I'm curious, just why now? Is it because of all the excitement and opportunity that lies ahead? And what do you think this is ultimately going to do for your business?
Well, it should be a positive for Cboe. We've been doing index options for a long time. What's changed here is that Robinhood wasn't able to handle what's called cash settlement. And so if you think about index options, they're different than traditional stock options because they're European style, which means they won't get called away on you. They just exercise at the expiration date, and they cash settle into your account, so you don't wind up with the stock or buying or selling a position. So those are great, and they have some tax advantages. So Robinhood's customers have been asking for this for a long time. Most other retail brokers haven't. And so we finally got to the point where Robinhood's ready, their systems are ready to handle that. And so we're excited about that. That should help with the client. You know, Robinhood came from nowhere, and today they placed the largest number of option trades of any of the retail brokers in the United States, which is a big surprise. And we want to help them be better option traders and use them to their advantage, but do it in the right way.
All right, Fred Tomczyk, thanks so much for joining us here. Great insight, and congratulations on the announcement. CEO of Cboe, thank you. Keep it right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back.
This week, investors have continued to see a rotation out of mega caps, with the Russell 2000 hitting its highest level since 2021. The equal weight Round Hill Magnificent 7 ETF down nearly 0.5 percentage point. But our next guest believes we'll see that rotation back into the Mag 7 over the next quarter. And that could kick off with earnings for those 7 names next week. With that, I'll kick off with Tesla first up. So for more, we're going to bring in Ram Ahluwalia. He is Lumida Wealth Management's CEO. Ram, it's great to have you on here. I do want to start on Tesla since it's the first of the Mag 7 set to report here. I know you're a bit bearish. Tell me your bear case.
Yes, look, Tesla is the most expensive name in Mag 7, and it's also seeing significant margin compression. It's facing the threat of EV competition from China and other players like Lucid and Rivian, and they've continued to fail to deliver against their roadmap year after year. The stock really hasn't gone anywhere in the past 3 years. It's a bit of a meme stock now. It's not driven by fundamentals.
Ron, what do you think the catalyst then is going to be to trigger that larger pullback? Because it seems like, at least yes, it had been off, but we had seen so much of that euphoria tied to AI really being able to kind of overshadow any of those challenges. And it seems like whatever Elon Musk just dangles in front of the investor, he's able to excitement. So what is it going to take in order to have that meaningful and maybe more long-lasting pullback?
We might not get one, just given where we are in the market. You're going to Q4, you've got positive seasonality, you've got Fed rate cuts. Elon has also tied the fortunes of his business to candidate Trump as well. So a lot of dynamics around this, a lot of narrative around this. It's not obvious that you're going to have a catalyst unless they, fail to hit delivery targets and get further margin compression. There is a lot of bad news out there in the stock too, but it's not. I don't think the risk reward here is attractive.
Real quick, Ram, is Musk's political activity part of your bearish sentiment on Tesla?
No, but he is linking Tesla to, the fortunes of candidate Trump, and that'll have some impact on the stock too, because the primary owners of the stock are retail investors. You don't really see institutions owning Tesla.
So it's a big mistake, you think?
That's right. Yes, exactly. I think what he's doing is lobbying for tariffs and protection against China competition. Right? China is producing not just EVs but solar at very low cost, and they're actually building high quality products. So Tesla needs tariffs to compete, and so that's the reason why he's allied himself with Trump. Although that's also upset another portion of his customer base too. So he's in a very complicated position.
Well, Ram, we've gotten 4 minutes into the interview without bringing up NVIDIA, so I've got to pivot here. We've gotten some mixed signals, right, from ASML, from TSMC. You've also got potential competition, I guess, from Cerebras here. Is the glory run over for NVIDIA?
No, I think we're still in the early innings for NVIDIA. NVIDIA clearly is capturing the bulk of the value capture in the sector and industry. We were very excited about NVIDIA. I think you'll see NVIDIA at $150 between now and the end of the year at some point. The hyperscalers, Meta, Google, Microsoft, and Amazon have each independently said they intend to spend $50 to $100 billion on GPU compute. The primary beneficiary of that is going to be NVIDIA. OpenAI just raised $6 billion. A significant portion of that spend will go to GPU chips. NVIDIA is really in a class of its own. It doesn't have a close competitor, not AMD, certainly not Intel.
Ram, do you think it's going to be the first then to reach $4 trillion?
Yes, there's no question about it. We made a call earlier this year that NVIDIA would be the most valuable company in the world. It achieved that milestone yesterday. And the demand for GPU chips is strong. And seeing enterprises start to get some ROI on it from the early adopters. Meta seeing ROI on their CapEx spend. So we think NVIDIA's got plenty of room to grow from here.
So thinking of the Mag 7 names, which is the AI winner for you?
NVIDIA is the AI winner. I would say Google and Meta also are AI winners at the application layer because they have data, right? Google has YouTube, which they can train on. OpenAI allegedly was training on the Google YouTube data. Google can enforce upon those IP rights if they choose to. Meta also has data from user-generated videos they can train on. They've also got an incredible AI team led by Jan LeCun. And crucially, they both also have distribution. They have billions of users. OpenAI needs to grow their user base, and they can finance their CapEx spending. They can finance their GPU purchases, whereas OpenAI needs to raise money from private markets or from their parent, Microsoft. And Microsoft has been pulling back on their CapEx spending because it's been hurting their margins. You can see Microsoft's actually lagging year to date the S&P.
All right, Ron, we got to leave it there. Thanks so much for joining us. Really appreciate it.
Thanks for having me. You bet.
Stick around for Wealth. It's coming up next hour. You'll have Brad Smith with you. Thanks for joining us and have a great weekend.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Hey, our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, we're talking about how to play the stock market heading into year end and 2025. Plus, are you overpaying for a financial advisor? Big question there. We'll discuss the best payment practices and the 3 questions that you should be asking your advisor. Plus, mortgage rates spiking for a 3rd straight week. We'll be joined by Glenn Kelman, CEO of Redfin, to discuss the state of the housing market ahead of your weekend house hunting. All that and much more during the hour. We got a lot to get to. Let's get to it here. But first, Let's do a quick check of the markets. We're 90 minutes into the trading day. The NASDAQ composite, that right now holding on to gains of about 0.5%, bolstered by an upbeat Netflix earnings results that we saw after the bell Thursday. The S&P 500 also gaining here. The Dow, however, being led lower by Amex, American Express, AXP, ticker symbol there. They cut their full year revenue forecast here. The three major averages, ultimately though, looking to notch their 6th straight week of gains. As we enter year 3 of this bull market, it has commenced. Here on how to position your portfolio into the year end and 2025 is Burns McKinney, who's the NFJ Investment Group Managing Director and Senior Portfolio Manager. I mean, Burns, at this point, we're, a stone's throw or, just a handful shy of that 50 marker, 50 new all-time highs here over the course of 2024. And so what is this market really continuing to look for or just latch onto in this broader momentum that we've been tracking, and especially amid an earnings season that can tend to have some of those more outsized names, send a broader signal across the market?
With the market hitting records, it seems seemingly daily or weekly, I think that, as a wiser investor than me that once said, don't fight the Fed. And this is a great example of that. Oftentimes when the Fed pivots to cutting interest rates, if they're doing that to stave off a recession, that's usually a bad sign for stocks going forward. But in this case, the fact that the Fed is doing it from a point of strength, they're really reducing rates not because they feel that a recession is imminent, but rather because the inflation-adjusted Fed funds rate has just gotten so restrictive that they're just it's trying to really bring it back to a neutral level. And so with the Fed cutting interest rates, that should provide a little bit of a tailwind going forward. And that's really what's been boosting equities, day after day, it seems like.
A tailwind for which sectors from your purview?
That's a great point and a great question. In fact, if anything, what we're seeing is because the economy has proven itself to be somewhat resilient, in many ways, a lot of investors are saying that you're looking at a little bit of a Goldilocks type environment. That's really keeps it primed for maybe a continued rotation away from a lot of what's really driven the markets over the last couple of years into some of the areas that have been out of favor. When the central bank starts cutting interest rates, places like the bond proxies tend to do well. That works well for utilities, industrials, and just anyone who's selling machinery and equipment also tend to get a bit of a boost when you do start seeing lower interest rates. And likewise, the industrials benefit from a lot of secular tailwinds, such as geopolitical turmoil is boosting the defense stocks. You still have a lot of dollars going out the door for the infrastructure spending programs. And just the reindustrialization of the United States provides a bit of a tailwind for some of those industrials names.
Just further down the line of what you were mentioning a moment ago with utilities, do you think that there's still room to run, considering the fact that we're taking a look at XLU here, even utility sector for the S&P 500, it's up 27% year to date here. So is utilities having an overflow or getting some type of bite or sniff at this AI moment even that we're seeing?
Well, if you pan out a little bit on your time horizon, there actually does seem to be a little bit more meat on the bone. Utilities, they trailed in 2022, they trailed in 23. In fact, 2023 not only was utilities the worst sector in the market, but their relative performance compared to the S&P was actually the worst relative performance for utilities since 1999. You're talking about, so you hadn't seen this bad a performance for utilities in 25 years. And so when one factors that in, when you factor in the fact that, we were just speaking about the fact that the market's hitting record highs, you're seeing high valuations on the market. There is a lot of uncertainty. And so that also makes a case for looking to something a little bit more defensive in the case of utilities, looking something like those dividend yields. And, as well, I think they're getting a boost from the fact that, yes, just increased demand for AI, cloud computing is starting to drive, rises in power demand.
Burns, while we have you, I got one of my first December 2025 S&P 500 targets in my inbox just before we came on air, and from UBS saying that they're looking and introducing a December 2025 price target of 6,600 for the S&P 500. With that in mind, what do you think needs to go right And what are the risks that the market needs to move through?
Well, as I noted, you don't want to fight the Fed, but that said, given the fact that you're looking at S&P with a price to earnings ratio of 23 times earnings, which over the last several decades, it's only been higher during a brief span in 2020 as well as during the dot-com bubble. So you're looking at high valuations, and if you look at the consensus forward earnings forecast for the S&P, right now those are factoring in 15% earnings growth next year, whereas over the last couple of decades, the average earnings growth has only been 8 or 9%. And so there are a lot of aggressive assumptions baked in there. So in many ways, that is priced for perfection. So what we're arguing is that, because the Fed does provide a tailwind, we do expect positive returns going forward. But it's really going to be, you're not looking at, long bombs down the field. It's probably more like, 3 yards in a cloud of dust. Investors should probably expect good enough equity returns in the coming 12 months.
All right. Well, Derrick Henry might love to hear that. Burns McKinney, NFJ Investment Group Managing Director and Senior Portfolio Manager. Thanks so much for taking the time, Burns.
Thank you for having me.
35% of Americans seek advice from a financial advisor or other professionals, according to Bankrate. But advice doesn't come for free. You got to pay these professionals. And to discuss how you can avoid overpaying for your financial advisor, we've got Alex Choi, who is the founder of Finance HQ, a platform that connects people with financial advisors and resources, live in living color here in studio with us. Thanks so much for taking some time today.
Yeah, thanks for having me.
How do people know when they are overpaying for a financial advisor?
It's a great question, and I think you really have to be mindful of the fact that there might be certain benchmarks you want to adhere to, but every case is unique. But for example, if you're paying on a percentage basis revenue share, basically you're looking for somewhere between 1% and 1.5%. Flat fee billing, a lot of advisors go through flat fees, and so you're looking at somewhere between $3,000 to $7,000 on an annual basis. Anything above that might be considered high, but you also have to consider the fact that they might be going above and beyond, doing things that are a little bit outside the normal purview. So again, just want to make sure that you're cognizant of that.
Certainly. And so what is that kind of service level agreement that people should have knowledge of when they are approaching or trying to select a financial advisor?
Yeah, a lot of advisors come to the table with, there's like this common misconception with a lot of individuals that all an advisor does is kind of pick and choose stocks, bonds, ETFs for you. But a good advisor will go well above and beyond that. They're going to help you with tax management strategies, risk portfolio analysis, just making sure that you have a good comprehensive financial plan set in place. And I think one of the most important things that a financial advisor does is set behavioral guardrails, prevent you from falling into the trap of making emotional decisions based off of market fluctuations.
What are 3 questions, perhaps, that people should ask their financial advisor, especially when they go to the dinner table and they're talking to the family and somebody brings up NVIDIA or somebody brings up, hey, are we invested or allocated in such and such asset? Or how are we positioning for the great wealth transfer, our financial future, all of these things? How can that translate into the questions that you're asking your financial advisor?
Yeah, I think there's a few questions you should come prepared to the table with. One of those being, are you a fiduciary? Meaning, are you morally and legally obligated to put my best interest forward? The second question I would ask is kind of just making sure that you understand, does this person have experience working in similar situations as mine? Have they been through a similar situation? And this actually provides color in a couple of different aspects. One, gives you peace of mind knowing that they've already done something similar to yours. But the second thing is this going to be a personalized approach to me and not just kind of a cookie cutter response based off of what they've seen with other people? And I think the third, almost most important question, and I highly encourage people to not be shy about this. What is your fee structure? What are you paying? What am I going to be paying for this service? At the end of the day, it's a question that most financial advisors are happy to kind of provide a response to.
A lot of people think that they need to be super rich to have a financial advisor. I mean, what is perhaps a fair way to get a foot in the door or just an entry point into a relationship with a financial advisor?
Yeah, I think there's a lot of advisors out there who do hourly billing, flat fee billing, and that might be the best thing for that particular individuals. There's a lot of good options out there, a lot of financial advisors who are willing to work with people who are in accumulation phase but haven't amassed a lot of wealth yet. And it's really perfect for them because it's going to help them kind of save along the way and be able to afford those services later on.
So, some people out there might think to themselves, hey, I've got, trigger warnings set up for, if something happens in the market, I get an alert, I know if I want to take action. It's almost like we're trying to use the technology to replace the financial advisor, what we might be able to pass off to them. And hey, I'm guilty of that too. Because, hey, I think I'm smart some days. But then there's the other ability to say, okay, well, this financial advisor might have access to more technology than I'm even paying for as well. How are we seeing financial advisors and the role there being changed by the technology that might be being used, whether that be AI or something else?
Yeah, I think financial advisors, there's been common concern that their jobs will be kind of reduced in scope because of AI and technology. But what I've seen is really good financial advisors embrace that, and they use it to make their technology, their practices even better, and they utilize it to make things smarter, more efficient, more effective. And so, I think people are driving towards AI in a positive way, but financial advisors who are embracing it are really able to kind of leverage it in a good way.
Alex Choi, who's the Finance HQ founder. Thanks so much for taking the time here with us today.
Thanks for having me.
Absolutely. Everyone, coming up, ahead of your weekend house hunting, we're bringing you up to speed on the state of the housing market. We'll discuss the trajectory of mortgage rates with the CEO of Redfin, Glenn Kelman. That's coming up next. Mortgage rates for the week ending October 17th are out. Our very own Claire Boston joins me on set with the numbers. Claire, what do we know?
So we saw mortgage rates rise again this week. This is the third consecutive week of gains. It's bad news for affordability ultimately, but it's good news for the economy because mortgage rates rise when the economy is doing well. It's all about kind of expectations about what the Fed is going to do. And right now we see that the Fed is probably not going to need to cut rates that much. And as a result, mortgage rates have been ticking up as traders kind of digest that information.
Absolutely. What does this mean for potential home buyers?
Right, so 6.44% is still more than a percentage point lower than it was a year ago. So folks I talk to say that if you're thinking about buying a home, you don't really want to try to time the market. Just go when you see a home that you like. That being said, every tick up in mortgage rates does take the affordability issue and make it harder for people who may be looking kind of on the margin.
It says that notably compared to a year ago, rates more than 1 percentage points lower. Potential home buyers can stand to benefit here from the release here. As we think to the folks that we've kind of rounded up some of the discussions with, I talked to National Association of Home Builders CEO about incentives as well that home builders are offering right now, even to offset some of these rates, including buy downs. And ultimately, would love to get your perspective here. What impact do these incentives like buy downs have on the broader housing market?
Right, so the fact that mortgage or home builders are really aggressively buying down mortgages, that can help affordability, for people who are looking to purchase a new home. We're seeing builders sometimes offer buy downs, into even sometimes that 4% range. And that really does help, some home buyers afford those purchases. That being said, the longer that mortgage rates overall stay high, the longer the home builders are going to have to offer those incentives, which does hurt their bottom lines a little bit.
All right, the Freddie Mac data and the release here also saying, hey, one of the ways that you could stand to benefit, shop around for the best quote, as rates can vary widely between mortgage lenders. Great to have you here, Claire, with us. Appreciate it. Let's stick with the housing market. Pending home sales rose 2.5% in September, according to a new report from Redfin. That is the biggest monthly increase in over a year and a half. Redfin attributing the rise in housing contract activity to falling mortgage rates and the Fed's rate cut trajectory. But for the past 3 weeks, we're actually seeing some mortgage rates rise. Here to react to what we're seeing in the entirety of the housing landscape, we've got Redfin CEO Glenn Kelman. Great to have you back on, and thanks so much for taking the time here, Glenn. First and foremost, just a broad read on what you're seeing in the mind of potential home buyers as it relates to mortgage rates. Sure, moving a little bit higher over the past couple weeks here.
Home buyers have mostly been resilient. So mortgage purchase applications are down 7% for the week. People do respond to higher rates, but I think they're being opportunistic because there's so much volatility in rates right now where they're bouncing up and down from day to day and week to week. We see people trying to lock a rate on a Friday before it goes up on a Monday, and trying to get under contract on that. There was a huge psychological milestone on September 18th when the Fed did make its rate cut. Mortgage rates had already priced that in. So I had been skeptical that home buyers would really react when the Fed made its move, but they did. So that has been a sea change in our business, a sea change in the real estate industry, where home buyers are back at a time when usually they're battening down the hatches for the holidays.
I want to come back to that stat that we were mentioning a moment ago, in home prices seeing that biggest increase since March. Ultimately here, what are you seeing and tracking among the home buyers that are running the calculus upon whether or not they want to go after some inventory that's already listed and already on the market versus a fresh and newer build out?
Yeah, well, that's always a difficult calculus. There's usually a premium on new construction, and some of the stale listings from the summer are going for less than the asking price. So sometimes we tell our customers right now, if it looks like you can't afford it, you might be able to do that. Rates have affected affordability. So over the past few weeks, the median monthly mortgage payment is up by about $100, but it's down $300 from where it was in April. So people are still staying in the game. I think if rates went higher, that would obviously deter them. But there's a feeling like we're going to stick around here and see if we can get a deal, because next spring, it might be a much frothier market where bidding wars come back.
And so with that in mind, if bidding wars were to return, and then you would see perhaps a driving up of prices even further with more participants in the marketplace. How critical then on the kind of new home side would it be for some of those buy downs and that really changed the thinking around where people are bidding in to existing offerings and existing listings versus where they're saying, hey, you know what, this might come at a premium, but at least there's a buy down, and how do you kind of monitor where that is impacting the existing listing side of the market as well?
Well, I think builders are just competing with home sellers in a different way. So if you're a builder and you've got 50 units, you want to maintain your price and secretly discount it by offering a bought down rate. Whereas a seller just doesn't care about the other listings in the neighborhood. So she's just happy to lower the list price and say, here it is. And even if that gets into the public records, it doesn't bother me. I shouldn't say happy to lower it, but there's just less of a shell game in terms of how the money is moving around. So a buy down rate is a real advantage. I'm not looking a gift horse in the mouth, but I do think that it's just a price discount in another form. And most listings, when they don't sell in the first 30 days, do the same thing. They just don't buy down the rate. They cut their home price.
Glenn, we're about inside of 4 weeks from the U.S. general election here, and it seems like, especially based on some of the data that you and your team have been able to publish and really survey and find out, home buyers, first-time home buyers, nearly a quarter of them holding off until after the election to buy a home. And so what does that tell you about either, number one, the pent-up demand sitting on the sideline, but then two, which way that could go if the buyer's candidate doesn't win?
Well, it might be a commentary on just how divided America is, because half of Americans think it'll be a disaster if Kamala Harris wins, and the other half think it'll be an economic disaster if Donald Trump wins. And so I have been surprised how many home buyers think that everything is going to change on November 6th. And I know both candidates have ambitious plans to increase housing supply. I'm glad to see it, but they do have to get those bills passed. And so, the first reaction is just going to be animal spirits. How do people feel about America now that Kamala is president or now that Trump is president? So I think many people are waiting in the same way they were waiting on the Fed. When the Fed made its cut, it didn't actually affect mortgage rates, but it did affect consumer psychology. And I think when the election is over, it won't actually immediately affect inventory, home prices, or anything like that, but it might affect home buyer and home seller psychology.
With that in mind, are there certain markets that you would be tracking where there could be a major delta in the difference between a Harris win or a Trump win?
No, not really. I mean, the markets that we're tracking right now are in Florida just because we're so worried about how folks are doing down there. There's obviously the direct impact from the hurricane, but also the collateral damage to the insurance market. It is just so expensive to buy a house. Most people think about the rate and the home price, but now there's a third factor in places like California and Florida, which is, can I afford the insurance? That's not a small chunk of change.
Yeah, no, a huge impact and a huge consideration, especially for those who are looking at buying a home and trying to figure out, okay, with the billion-dollar disasters as Noah tracks, what is the best option for you, yourself, your family? Redfin CEO Glenn Kelman, thanks so much for taking the time.
I love being here. Thanks for having me.
We love having you on. Thanks so much, Glenn. Coming up, everyone, changes to Medicare plans affecting millions of Americans. We've got the tips, though, to help you navigate this year's open enrollment. But first, how much house can you afford? Yahoo Finance's Rochelle Akufo has an answer.
Owning a home is as American as apple pie and baseball, yet the promise of achieving the American white picket fence dream seems more elusive than ever. In 2024, the median price for a new home is $495,750, a price that's out of reach for 77% of U.S. households, according to the National Association of Home Builders. The median household income, meanwhile, is $80,610, according to the Census Bureau, suggesting the gap between how much a house costs and how much one can afford remains wide. Even with that gap, experts say real estate prices vary widely by zip code, and there are still ways to achieve home ownership. So how much house can you afford? Here's how to figure that out.
The really obvious factor that affects housing affordability is the home price itself. But there are two other factors that are really important for housing affordability. One is the mortgage rate. The other major factor is, of course, incomes. So those are the three legs of the housing affordability stool.
Of course, affordability is a quality of life calculation, so only you ultimately get to determine what works best for your monthly expenses and budget. But determining how much house you can actually afford starts with some basic details that will help you figure out what your biggest and most important monthly cost should reasonably be. A key first step is to plug the following into a housing affordability calculator. Your household gross income, that's your annual pre-tax income. Your debt, think monthly payments on loans and credit cards. The down payment, a percentage of the purchase price of the house paid up front. The loan term, the duration of the loan. Interest rates, interest paid during the loan term, which can vary based on credit score and market conditions. Mortgage insurance protects lenders in case a borrower defaults. Property taxes, a variable cost paid to local governments based on the value of the home and the land it's on. And of course, closing costs. To start, identify your household's gross annual income and gather 3 months of bank statements to estimate your debt payments. Plug that into the calculator. For this example, let's use $100,000 as the gross annual household income, a bit more than the median, with monthly debt servicing payments of $500. Lenders assess the percentage of your monthly income that goes towards paying your debts, your debt-to-income ratio, to determine your financial health and ability to take on a mortgage.
A lot of people go with the 30% rule of thumb for the housing costs. That's keeping your housing costs to no more than 30% of your gross income. Anything in that range should be comfortable for most people. But like most rules of thumb, you should think about how it applies to you individually.
Next, estimate how much down payment you can comfortably afford. Your down payment is usually the largest upfront cost. For this example, we'll use $10,000. Next, consider the loan term. A 30-year fixed loan is the most popular, where the interest rate stays constant or fixed throughout the life of the loan. We'll use a 30-year fixed for our example. Your mortgage will be your largest ongoing monthly payment. All the information so far and market conditions factors into the interest rate the lender offers. We'll use an interest rate of 5.795% with monthly property taxes and private mortgage insurance of $375 and $100 respectively. With all this data plugged in, a recommended affordable home price for a household with $100,000 gross income comes out to $329,902, while the loan principal and interest is $1,875. The total monthly mortgage payment, which includes property taxes, homeowners insurance, and mortgage insurance, is $2,500. You can adjust the home price accordingly if you want to spend less and see how much financial strain could be added if you spend more than you can afford. One thing to also remember, you need to factor in those closing costs, between 2 and 6% of a home's total purchase price. It's important to note that buying a home is a transaction, while owning a home is an ongoing budgeting consideration beyond the monthly mortgage. Save 1% of your home's purchase price for repairs and maintenance, because that's on you too. And don't forget about property taxes.
Property taxes tend to go up over time as costs for government services rise. I think when people are looking ahead and trying to think about how their housing costs will change over the long run, using a percentage of the home's value when thinking about property taxes or insurance is a good way of accounting for that. It takes time and preparation to get into the housing market. So making those little steps to save and prepare now to get your finances in order, I think that those are the right steps to take. And then, of course, anything you can do to improve your income, whether that's focusing on your career or taking on a side hustle, can also help you realize that dream of homeownership sooner rather than later.
Medicare open enrollment season is underway, and this year there are some changes that could make it harder to navigate, so we're breaking down everything that you need to know. Joining me now, we've got Philip Moeller, who is the author of Get What's Yours for Medicare. Philip, great to have you here with us. So what are some of the biggest changes this year?
There are two big changes that people need to know for open enrollment. The first is that the Inflation Reduction Act, which the Biden administration passed in 2022, will make big changes in drug prices next year. It sets a $2,000 out-of-pocket cap on the drug costs that people on Medicare need to pay. That's a big win for people who have expensive drug needs, but it's triggering a bunch of related changes because drug companies and pharmaceuticals that have to pay for that $2,000 cap are going to be looking for ways to get some of their money back from the Medicare enrollees who don't have expensive drug prices. So you're going to be seeing changes in deductibles, copays. Drugs may move from one pricing tier into a more expensive tier, and some drugs may be dropped entirely from the plan. All of this means that you need to pay attention to open enrollment this year. It's not a business as usual period. The second big shift is with private Medicare Advantage plans. These plans have become incredibly popular. More than half of all Medicare enrollees now have Medicare Advantage plans. But these plans are facing some business and regulatory headwinds. And so plans have decided to actually leave some geographic markets. Plans may be changing terms of their coverage. You may know that these Medicare Advantage plans have become really popular because they provide routine coverage of dental, vision, and hearing needs. These are things that traditional Medicare is forbidden by law from covering. So they've made the plans really attractive. But some of these plans may sort of peel back some of these benefits and reduce them. The only way to find out for sure is to check Medicare's online comparison shopping tools, which are really good and which are really underutilized in order to figure out whether or not your plan's changing.
And so, Phil, what do people need to consider when they are navigating the Medicare open enrollment, specifically with some of these changes in mind?
Well, the first thing I urge people to do is don't rush to judgment. Open enrollment started October 15th, and all the marketing message you get from people say, oh, you better decide things right away. This is an urgent period. Well, it's not. Open enrollment lasts through December 7th. Even if you waited until December 7th to elect your 2025 coverage, it will still take effect next January 1. So don't be in a hurry. Take your time to look at these plans. Now, the first thing you want to do is, if it's a Part D drug plan, make sure your drugs are still covered. And Plan Finder, which is the generic name of these comparison tools, will allow you to put your drug list in the tool. And when you ask for plans available where you live, it'll show you the plans that cover your drugs. Second thing to keep in mind is that a low premium isn't necessarily reflective of your annual out-of-pocket costs. You need to look at those costs. Again, this tool projects your annual expenses, assuming you take the drugs that are listed in the plan formula. The thing with Medicare Advantage plans, do the same thing. But I would add that I would call my current doctors and say, are you going to be in this plan next year? Now, the big thing about open enrollment is it's an annual do-over. You can't be denied change in coverage by pre-existing conditions. It's a great annual chance, sort of a checkup for your health insurance. And so in terms of doing this, you have the option to move from traditional Medicare to Medicare Advantage. You can move from Medicare Advantage back to traditional Medicare. You can change your Part D drug plans. You can change your Medicare Advantage plans. So it's really a pretty terrific pro-consumer set of capabilities that annual enrollment offers to people every year.
So just lastly, and I got to hustle to my finish here, but just lastly, what do you do if your prescription or what you've been prescribed or the drug that you were on that was previously covered is no longer covered?
Well, for example, I'm going to change my plan because it dropped one of my drugs, but I've been able to find other plans to cover them. If you cannot find a single plan that covers your drugs, I won't lie and say it's an easy path forward, but you should contract your prescribing physician. And the physician can request an exception for a plan, and it can say, I'm sorry, but my patient needs to take this drug. There's no similar drugs that are going to give him the health benefits he needs, and you have to go through this sort of dispute resolution process with the plan. Not always successful, but it's the next step you would take.
That's valuable advice there. Philip Moeller, who is the author of Get What's Yours for Medicare. Thanks so much for taking the time here in the breakdown, Philip. Appreciate it.
Sure. My pleasure. Take care.
Certainly, you too. We're breaking down how consumers are spending this holiday season right after the break. Stick with us. Online spending is increasing year over year, and low-income spenders are driving the rise as they look for virtual deals, according to Bank of America. To discuss holiday spending trends that they're seeing, we've got David Tinsley, who's the Bank of America Institute senior economist. David, great to have you back here with Yahoo Finance. So first and foremost, what are you seeing specifically in the deal searching and the promotion hunting right now among consumers?
Well, what we've seen is that, and if you go back to the pandemic, of course, you saw this big spike in online, and everybody was kind of expecting that to recede. But actually, over the last 2 years, we've begun to see a rise in online spending again. And when we dig into who's driving that, it's the lower income consumer. So we think, in part, this is around the stuff we've heard a lot about value seeking, trading down, that kind of thing. Now, when you look just at holiday spending, the traditional bricks and mortar Main Street pattern is two spikes in holiday spending, one around Black Friday, one in the build up to Christmas Eve when everyone's panicking that they haven't brought enough gifts, etc. Now, what's increasingly happening is those peaks are coming down, and the peak around Cyber Monday is rising. So it does look like people are doing more online and doing more earlier.
And so with that in mind, and I was just about to ask you that, does it seem like there are retailers online that are positioned best to benefit, especially as you think about the online realms that people can have first top of funnel awareness into that kind of purchase decision that they're making as well?
Well, I think that's right. We've done a lot of work at the Institute recently around trading down, and we've seen, that trend has risen markedly amongst lower income households. So we think, this online online spending increase is really them looking for these deals. And of course, as everybody knows, you can cover a lot of retail territory online compared to sort of trooping around the mall, for example. So I think that's a part of the story.
We often think about the pull forward in some of those promotions when I consider how Prime Day gets earlier and earlier, or there are more Prime Days that are announced. These basically sales bonanzas and blitzes that other retailers also say, hey, you know what, we've got some deal days that we'll announce too, and we'll just throw some deals out there for our customers. So all of these things considered, when you see a pull forward like this in some of the promotions, what does that set up for some of the typical holiday spending later on in the season, around or even after Thanksgiving?
Yeah, I mean, that's a really good question. So is this pull forward, or is it that it heralds a strong holiday season? Obviously, we'll know in at the end of the day when we're through it. What I'd say is that in the work we've done around the consumer at the Bank of America Institute, generally we've been quite upbeat on the consumer. The labour market for most parts of the consumer is pretty robust. As you saw in payrolls report, wage growth is still pretty solid, and they've still been spending. So I would probably err on the side of optimism that this pull forward, this early surge in online spending, isn't necessarily cannibalizing spending later on.
David, as I think back to my own shopping over the years and, growing up, going to the mall, walking around with friends, it's vastly changed. And digital is one of those forces that's really kind of reinvented the retail landscape and caused a lot of customers and the people who are powering those retail experiences to rethink that connection point. But as I think about malls, where is the mall place? Where is the brick and mortar place still within retail, and how's that percentage changing from the consumer's mindset and where they're going to spend?
Yeah, so what we've seen in our spending data, and we've looked at the spending amongst bunches of stores that are particularly cited in malls, is that there's a real kind of two stories going on. For higher income consumers, their mall spending is held up pretty well. And we think, that's going to be associated with obviously higher end malls, perhaps more luxury type stores in them. The lower income consumer, on the other hand, their spending at malls has continued to decline. There's about a 20 percentage point difference between those two groups. So I think, that speaks to this widening differential between, in a sense, the higher end malls and the lower end malls.
Have digital deals killed the doorbuster?
Yeah, that's a good question. So, I do think this online trend is here to stay. And I think, part of it's generational, but I think what the pandemic did was also kind of confront a lot of older generations with what they could get out of online spending as well. So I do think there's been something of a structural change.
David, always a pleasure to get some time with you and get some of your insights as well. Great data. David Tinsley, who is the Bank of America Institute senior economist. Appreciate it.
Thank you.
With spending for the holidays on the rise, you might want to make a little extra money for that spending cash. And here with some of the tips to do just that, we've got Shinabu Hundert, who is the financial planner and founder of Empowered Planning. Shinabu, great to have you here with us. So how does someone find the best side hustle for them ahead of this holiday season?
You can start by just assessing your skills and what you're interested in. Consider seasonal work. This is a great time of year for that. Indeed.com just published the 10 fastest growing seasonal jobs. And at the top of that, you have a retail sales associate, restaurant staff. So if you know you're going to shop at a specific store anyway and you like it, see if they're offering part-time opportunities for you to get a job there. You can also look at pet and house sitting services. A lot of people travel during the holidays, so they don't want to leave their houses unattended. They don't want to leave their pets sitting, in a kind of pet hotel. So look at sites like Rover and Wag if you want to dog sit, and look for other those. TaskRabbit, Upwork, you can do gig economy work. This could be something like graphic design or handyman work. It could also just be helping out busy parents who want to decorate their homes and also gift wrapping. So if you have a car, you can do food delivery services or Uber or Lyft. There are lots of opportunities this holiday season.
And so with all of that in mind, say you've been able to successfully look at your calendar, look at your schedule, add in perhaps a little side gig to make a little extra cash as well. Then it comes to budgeting on the other side of that. So how do you build a budget for the holidays and as they say, ball on a budget, if you will?
You should make a list of categories instead of just saying like this lofty holiday budget. What are the people that are on your gift list? Are you going to be traveling? Set entertainment budgets, or maybe it's buying new holiday decor, and make the list with the limits on there so you don't go overboard. If you have the opportunity to, I would set up a separate savings account where you're carving off money right now into this account to know that's my holiday budget. So you have visibility into how much you're spending, and then leverage budgeting apps like You Need a Budget or Honeydew, Rocket Money, and there's even something called Christmas Gift List Tracker.
Oh, interesting. Okay, all right, I wrote those down. Just additionally, while we have you here, I wonder for those who have built their budget out and are trying to make sure that they don't go overboard, but they know that they're going to perhaps have to swipe or tap a credit card at some point or another. How can you implore smart spending, even as we were just discussing the amount of promotions that are going to be out there, and ensuring that you make it through this holiday season without going into or adding on too much more debt?
Try to avoid taking on that credit card debt. It looks like Americans on average, it takes them about 5 to 6 months to pay off credit card debt that they accumulate during the holiday season. So if you are going to add extra expenses like these buy now, pay later options, set a limit on that to say, I have wiggle room of $300 extra a month I can put towards that. So don't go over that amount, and just get used to saying no, or, different options that are available, because you don't want to be digging yourself out for 5 months just to give somebody a gift. That's not what the holiday season's about.
Absolutely, great point. And just lastly here, as you think about making it through and paying down some of that, how do you begin to kind of on the other side financially plan for paying down that debt, knowing that, hey, I didn't try to take on this much debt during the holiday season, but I also don't want it to take 5 months to pay down on the other side of that? How can you kind of snowball that, if you will?
It's really important right now to look at what you have available in your discretionary income, because if it is only $200 a month or $300 a month that you have, it has to be within the confines of that. So rather than putting something on a credit card, you can do these buy now, pay later options. But once you get to that $300, leave it at that. And then when January comes, you're not having these moments of shock or shame that's often associated with it. So keep it within those limits, and use an app so you have alerts. You're keeping it top of mind, and you're not, checking it out on your credit card statement a month later.
Shinabu Hindert, who is the Empowered Planning founder. Shinabu, thanks so much for taking the time.
Thank you, Brad.
Certainly. Watching your favorite shows could now mean paying more. We're breaking down the cost of streaming services next on Wealth. Streaming services are raising prices again. Disney hiking the price of various plans this week. Joining me now with why. Why'd they do it? Yahoo Finance's Alexandra Canal. All right, so we've been seeing this streamflation trend play out over the last few years here.
Yeah, and unfortunately, Brad, it's a trend that we're going to continue to see. It's not going away anytime soon. The Disney price hikes, they went into effect on Thursday after the company first announced the changes were coming back in August. The increases affected various plans and tiers across Hulu and Disney Plus, along with Hulu Plus Live TV. Earlier this year, we also saw price hikes at Warner Brothers Discovery's Max streaming service, along with Comcast Peacock. And there's a new survey out that shows just how much consumers are willing to tolerate. According to the survey conducted by market research firm OnePoll in conjunction with Forbes, Americans spend an average of $46 a month for streaming services, with Netflix serving as the most popular choice. 45% of respondents admitted that they've canceled a streaming subscription within the last year because costs were too high. And when it comes to the services consumers are most likely to drop if prices increase, Disney Plus leads the way, followed by Hulu and ESPN Plus. So bad news all around for Disney, which, like we've been discussing, just raised those prices. But I also want to talk about Netflix, fourth on that list right there. The company just reported earnings, beat estimates across the board. The stock is trading at fresh all-time highs as a result. But Netflix has been very careful not to raise prices too quickly. They really take a holistic approach to decide if and when they should implement prices. We have yet to see a U.S. price hike from the streaming giant this year, although analysts do say it's still a possibility heading into 2025. Here's what Netflix co-CEO Greg Peters had to say on the earnings call when asked about price increases from competitors and whether or not the company's $6.99 ad-supported tier was priced too low. Take a listen.
We try to think about our pricing mostly, not in relationship to competitors, but, from the value that we're delivering to members. So we want to have a range of price points. We think that that's healthy. I think it's also important to say that we love the low price point and increased accessibility that comes with our ad plan. If you take the US just as an example, $6.99, I think it represents an incredible value.
So Netflix really making sure that engagement is at healthy levels, that people are consistently watching and staying on the platform before raising prices. We have seen price hikes overseas, though. Scandinavia, Japan, they announced price hikes coming to Italy and Spain. But we have not seen a U.S. price increase since last October. So we're approaching the year mark of no increases. And like I said, analysts really expect this to come at the end of the year or maybe at the beginning of next.
Keep them away. We don't want the
we don't want them.
Here in the
Netflix,
US.
the premium plans are a bit on the pricier side. So.
Has the content gotten that much better that I should be paying more?
Well, there are some content catalysts, I guess you could say, coming up with the Squid Game sequel. We have a Happy Gilmore film coming out. So Squid Game season 2, I should say, which I know a lot of people are excited about. We just had a lot of key programming this past quarter with Nobody Wants This. Were you a fan of that? Did you watch it? You should if you haven't. I'm obsessed.
No, I didn't watch that one.
Kristen Bell, Adam Brody, gotta watch it. So I will say the content is good despite the strikes that we saw last year, and that's something that analysts have said a lot too, that the fact that we saw subscribers up, engagement still flat year over year, but still over 90 billion hours watched in a 6-month period. That's positive for Netflix.
I'm still working through Love is Blind. All right. A lot of
Aren't
things.
we all?
Working through it in multiple ways.
Yes.
Alexandra Canal, thanks so much. Appreciate
Thanks,
it.
Brad.
That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close. You don't want to miss it.